Good morning.
Good morning, sir.
Good morning,
Good morning,
sir.
sir.
How are you, sir? Long time no see.
All right. Yes, wake up. Come. I think some of them. Why videos are off? Quick. All right. I know it has been very tiring. Definitely, it would have been. Alva. Yes or no? Full Josh ಇದ್ದೀರಾ ಇವಾಗ್ಲೂ? ಇರ್ಬೇಕು.
Yes, sir.
Full Josh, sir.
Yes, sir. Full Josh. I want the same Josh now also. Correct? ಇನ್ನ ಮುಗ್ದಿಲ್ಲ. Yes or no? ಇನ್ನ ಮುಗ್ದಿಲ್ಲ. Correct? Few more subjects and then you need to do your revision, and finally your examination is still there, so you have to maintain the same Josh or Benki fire. That Josh should be there even now. Okay na? Yes or no?
Yes, sir.
Sir. Okay. All right, so let's start. I think your FM revision material has already been circulated, and Shetty sir and SMS sir have completed their portions. We're left with my portions for FM. Yes or no? Yes.
Yes,
All
Yes,
of you
sir.
have taken all of you have taken printouts. Printout ತಗೊಂಡಿದ್ದೀರಾ?
Yes.
Yes, sir.
Yes, sir.
Good. Then we can straight away start with the cost of capital. Yes. So what do I mean by my cost of capital? Yes. What is cost of capital? It is the return that is expected. Yes or no? It is the return that is expected by those people who are investing. It could be either my equity shareholders, preference shareholders, my debenture holders, etc. Correct? It is the return that they expect, and it is not what the company pays. Yes or no? Initially, when we started off, yes, when you start with the concept, you all would have thought that okay, what do I mean by cost of capital? It is the amount that the company is paying. No, it is not just the amount the company pays. Rather, it is the return that they expect. Yes or no? It is the return that they expect by the providers of capital. That is my cost of capital. It is also called as what? It's also called as cut-off rate or hurdle rate. Yes, it's also called as cut-off rate or hurdle rate. Why do I call it as cut-off rate or hurdle rate? Because that is the minimum expectation. Yes or no? If you are evaluating a project, then minimum your cost of capital you have to get. Correct? Minimum cost of capital, the return should be at least equal to the cost of capital. Only then it is an investable project. That would have already learned even in your investment decision chapter, right? So then we learned what is the significance of cost of capital, evaluation of investment options. Yes, financing decisions, that is choosing one of the sources of finance. Correct? Where did we learn this? Which source of finance to pick? Yes, so that your cost of capital is the best. We learned about capital structure theories, all of these things, right? So evaluation of investment options, your financing decisions, and lastly taking capital budgeting decisions. For all of this you need your cost of capital. Okay, so you can keep your caps material open, right? First one, directly getting into the equations. Okay, now I will not be spending a lot of time on theory. Yes, I will not be spending a lot of time on theory. Quickly, just 15-20 minutes for each chapter only on theory. Then straight away I'll be getting into problems. I'll try to solve as many problems as possible and mark all the important adjustments so that becomes easy for you guys. And you should be in a position to solve all the problems that is there in your revision material, and probably 1 or 2 important problems of what was done in the class also. Okay, that you should go through. All right. So coming to this cost of long-term debt. Yes, cost of long-term debt. What is it? Very simple. KD. We call it as KD. Yes. I into 1 minus T divided by net proceeds. Remember all of you. Why 1 minus T? Because of tax. Yes or no? Tax advantage. Remember the concept of tax advantage, right? Because interest I pay, but on that portion I also get a tax benefit. I'm able to claim it as my expense. So into 1 minus T divided by net proceeds is my KD formula. Next, redeemable debt. That means, right, I have to when it is redeemable. So all of this, if it is irredeemable, then the formula is I into 1 minus T by NP. If it is redeemable, that then the formula is RV minus redemption value minus net proceeds divided by N. Idu N il barbeku. Yes, this N should be here. Okay, divided by N, the whole divided by RV plus NP by 2, and this is your same thing, numerator is same, I into 1 minus T. Remember this formula, all of you. It's also called as approximation method. Okay, next. Cost of preference share, very simple. Preference rate divided by P naught. Again here, when it is irredeemable, this is the formula when it is irredeemable, correct? This thing is this is in the denominator. Okay, P naught, that is net proceeds. When it is redeemable, yes, you write it here, clear, you write it. Yes, all of you write the formula. PD divided by, PD plus, this N should be here. RV minus NP by N, the whole divided by RV plus NP by 2. Correct? This is my formula for KP. All of you remember this? Cost of preference share, similar to my cost of debt. However, only difference is there is no share. Yes or no? Because on the preference dividend, you cannot claim tax expense. So therefore, PD plus RV minus NP by N, the whole divided by RV plus NP by 2. Okay. Next, cost of equity. We have various approaches. First one is dividend price approach. Correct. Again here, D1 by P naught. D1 means after the end of year 1, expected dividend. P naught is the current market price. Yes. Today, what is the market price? I consider that. And I consider dividend at the end of year 1. Yes. If today I'm standing at the end of the year, what is the dividend that is to be given? That is my dividend price approach. Clear, all of you? Next. Earnings price approach, right? That is what? EPS by P naught. So same thing, right? In both the cases, we are not expecting any growth. Yes. What is it here? We assume that it is constant forever. It is constant forever. And EPS also, when it is assumed to be constant forever, then earnings price approach formula is very simple. EPS divided by P naught. All of you clear? Instead of dividend, you will write EPS. Gordon's model, again, write the formula. Yes, KE is equals to D1 divided by P naught plus G. D1 divided by P naught plus G. Yes, P naught here, obviously it should be net proceeds only. That is after minusing flotation cost. After minusing the flotation cost. Clear?
Yes,
Then growth rate. Okay, growth. How do I calculate my growth rate? If you remember, very simple. Yes, if they've given you, say, dividend after 7 years is so much. Yes, current year dividend is what? So using your time value factor, yes or no? Using your time value factor, you will calculate it. Remember this, the simple. So dn is equals to d naught into 1 plus g to the power n. Yes, wherein, say if they've given you after 7 years, dividend is 100. Today it is 50. Then at what rate it has grown? Use this formula, you will get it. Clear, all of you? Yes. So wherein G is the missing figure, N you know for how many years, that is 7 years, right? D naught, current dividend, how much it is. At the end of 7th year, how much it has become. Use this formula, you'll get it. Or Gordon's growth model, G is into B into R. G is equals to P into R, where P is what? It is your retention rate. Yes or no? The B is my retention rate, which is nothing but 1 minus dividend payout ratio. It is my retention rate, and R is the rate of return on funds invested. Yes. So what we are trying to say is simple, right? More and more the company retains, it can grow more. Yes or no? More and more the company retains, it can grow more at the same rate, right? At the same rate as the rate it is getting. So that is why it is G. Okay. CAPM approach is very simple. Risk-free rate, you should get KE. Risk-free rate is the minimum expectation, so that it should always be there. Then you are investing, say, in the markets, yes or no? In the market, so you need a premium if you're investing in the market from the risk-free rate. So this is called the premium, yes or no? But however, if you're investing in a particular company, it will have certain beta value which is more riskier than the market itself. Correct? It is more riskier to invest in one company than to invest in the entire, say, Nifty index. Yes or no? Rather than to invest in the entire Nifty index, obviously investing in one particular company will be more riskier, or maybe even little less riskier, depending on which company you're choosing. So that is why it is called beta. Clear, all of you? So you multiply that beta into RM minus RF, which is my risk premium, and you add it to RF, you get KE. Clear, all of you? Remember this formula? So
yes,
KE equals to RF plus beta into RM minus RF. Okay, now the required rate of return is risk-free rate and risk premium. For risk-free rate, you're covering the time value factor. Yes, and risk premium is nothing but beta into RM minus RF. Here, differences of systematic risk and unsystematic risk is given, which you guys can go through. Okay, now meaning why risk is inherent to the entire market segment. Correct? Systematic means what? It is inherent. Unsystematic means it is specific to the company or industry, correct or not? It is specific to the company or industry. This is what? It is uncontrollable, correct? It is uncontrollable. This is controllable by the organization, correct or not? Unsystematic risk. Who's telling you to invest in that particular company, correct? You can control by diversifying. Unsystematic risk can be controlled by diversifying, yes or no? So macro and micro in nature. Inherent risk, this is based on business risk, liquidity risk, and credit risk is involved here. Also known as market risk and non-diversifiable risk. So CAPM considers which risk? Diversifiable or non-diversifiable? Check here. CAPM considers only non-diversifiable risk, as diversifiable risk can be eliminated. Yes, it can be eliminated through diversification. So CAPM, when I call this beta, it is basically considering only my diversifiable, or rather it is my systematic risk. Okay. Next, cost of retained earnings. Normally, if nothing is given, KR is equals to anyone. KR is equals to KE. Yes or no? Normally, if nothing is given, KR is equals to KE. So if you see the formulas, it is the same. D dividend by P naught. Yes or no? EPS by P naught and D1 divided by P naught plus G. However, important, this is the difference. Yes. P naught in KE will have flotation cost. Obviously, in retained earnings, that flotation cost is missing. That is the major difference here. Understood, all of you? That is the difference here. That is only if the question has given information, right? Normally, what we have seen is most of the questions, the flotation cost information may not be given. So in such a case, you can assume KR to be equal to KE. Okay. Next. This is another formula given in your material, that is KR, that is retained earnings, is equals to KE into 1 minus personal tax rate. It gets taxed in my hands. Yes or no? 1 minus personal tax rate into 1 minus flotation cost. That is the KR formula. This one, if they give you a small question, maybe a 2 marker or something like that, this might come, or maybe 5 marks maximum. Question. Okay. Weighted average cost of capital, it is also called composite costs. That is, when I combine the cost, overall cost of capital, when all the costs are combined, I call it as weighted average cost of capital, correct? So we learned till now all the specific costs of capital. That is, debt cost is how much, preference cost, then your retained earnings, cost of equity, etc. If I have to find out what is the weighted average overall cost of the company, that is what is weighted average cost of capital, wherein very simple, you find out the weights, yes or no? You find out the weights of each and every source of finance, whether it is equity, whether it is debt, whether it is preference shares, whether the retained earnings, find out the weights for all of them, multiply into the respective cost of capital. When you multiply, you get and add all of this, you get the weighted average cost of capital. Remember, all of you? Yes,
sir.
So here you have two choices of weights here. Yes or no? You have two choices of weights. Either you go with book value or market value, which is better. Yes, obviously, market value represents what? Market value represents the correct picture and is more accurate. Yes, it is more accurate as it represents the firm's capital structure more accurately. Okay, now. Yes, however, this is easy. Yes, this is easy. Convenient. Book value is easy and convenient. Okay. Market value, however, represents the correct picture. And important points. This is important for your problem perspective. Share price already incorporates the effect of reserves. So therefore, do not add reserves again. Remember, yes or no? For book value, you will have equity. You will have reserves separately, correct or not? But however, this is for book value. For market value, you get combined figure always. Okay. It incorporates reserves already. Even they would have mentioned that equity. They would have mentioned what? Equity. Market value is so much. Please know that it is incorporated. It is already incorporated, that the reserves value is already incorporated. Okay. Next, market value of term loan is nothing but the book value. Correct. Market value of term loan is nothing but the book value, and target weights, that is, refers to optimum weights determined by the management, which, however, I don't expect anything much from that. Marginal cost, whenever there is new or incremental, yes, underline that, incremental. Yes, in note you should all underline. Yes,
Underlining, sir.
New or incremental cost of new capital issued by the company. So any additional capital you're raising, it could be through any means. Yes, it could be through debt, preference shares or equity, etc. That additional capital that you raise for the purpose of a project, etc. is called marginal cost of capital. Yes, marginal cost of capital. If the weights is same as the existing capital, correct or not? If it is raised in the same proportion, that is nothing but your weights, correct? There's nothing but the weights. If the weights is same, then your marginal cost of capital will be equal to weighted average cost of capital. Understood? Yes. If the new source of capital that you're raising is in the same ratio, then it will be equal to weighted average cost of capital. So as I said, I've completed it in 15 minutes. Okay, now come now. Let's start with the problems. Okay. Yes, cost of capital 130. Yes, RTP November 23. Yes, all of you concentrate. JSL Limited is planning to raise additional finance of 20 lakhs for meeting its new project plans. It has 4,20,000 in the form of retained earnings available for investment purposes. Further details are as following. Debt equity mix is 30:70. Cost of debt up to 3,60,000 is 8%. Beyond 3,60,000 is 12%. Earnings per share given is 4. Dividend payout ratio is 50%. Current market price per share is given, yes, 44. Expected growth rate in dividend is 10%. Tax is 40%. Okay, now tax rate is 40%. Determine the cost of retained earnings and cost of equity. Determine post-tax average cost of additional debt. Determine the pattern of raising the additional finance and compute the overall weighted average after-tax cost of additional finance. Okay. Yes. Let us see now one by one. First one, KE. What is the formula for KE? What is the formula for KE? D1 divided by P naught. Yes or no? D1 divided by P naught. Yes. So cost of equity is here. Yes. D1 divided by P naught plus G. D1 divided by P naught plus G. So where D1 is equals to D naught into 1 plus G. That is, what is D naught here? Check here. Earnings per share is 40. All of you are getting it? Earnings per share is 40. Yep. Dividend payout ratio is 50%. Therefore, can I say dividend is 2? Can I say dividend is 2? 50% of 4 is 2, correct? Into 1 plus G will give me my D1. Okay, now? Yes, into 1 plus G is
P naught plus G.
Yeah. Ritvik, I think you have network issue. Okay, so K is equals to 2.2 divided by P naught. It's given here, guys. P naught is 44 given. Okay, divided by 44 plus G is also given 10%. So KE is 15%. I hope everybody understood. Yes, KE is 15%. Next, cost of debt is, check the question here. What is the cost of debt? Cost of debt is 2. In two forms they're given, 8% and 12%. So now you need to understand. Okay, first so we'll find out for both. Okay, 3,60,000 and for beyond 3,60,000 how much it is. So one is 8%, one is 12%. So 8% into 1 minus T and 12% into 1 minus T. Did you understand? 40% is the tax rate, multiply minus both. So 4.8 and 7.2%. Now next very important is how to find out the, okay, write down, because they've not given that working note properly here. Additional finance 20 lakhs. Additional finance 20 lakhs. For this, draw 2 arrow marks. 2 arrow marks. Left hand side, debt. 30%. 30%. Okay. Debt 30%, that is 6 lakhs. Right hand side, equity 70%. 14 lakhs. 14 lakhs. Okay. So 6 lakhs, okay, 2 arrow marks. That is, first is up to 3.6 lakhs. Yes or no? First is up to 3.6 lakh. What is the interest rate? Interest rate is 8%. 8%. Right hand side. For the balance, for the balance 2,40,000. For the balance 2,40,000, interest rate is 12%. Okay. Interest rate is 12%. Next, right hand side, 14 lakhs ide. For that, again draw two arrow marks. Two arrow marks. First one, retained earnings. Retained earnings. 4,20,000. 4,20,000. Right hand side. Therefore, equity shares. Equity shares. Equity shares is 9,80,000. 9,80,000. Clear?
Yes, sir.
Yes. So now let us come back and see the computation of KD. So in the same proportion as given, we will have to compute it. Check here now. So 4.8 and 7.2 we computed. I hope everybody is understanding this much. Yes or no? Yes.
Yes, sir.
Want to go
Yes,
slower?
sir.
Okay, clear? Okay. Next, check here. Post-tax additional debt. So 4.8 is 3,60,000. Yes or no? So 4.8% into 3,60,000 divided by 6 lakh plus 7.2% into 2,40,000 divided by 6 lakh. You find out the cost is 5.76%. Artha aita? In the ratio, in the same proportion, you need to find out what is the KD. Okay, na Naman? Yes. Pattern for raising additional finance. Yes, this is what? This is my working note. Refer to the working note. Aste. Okay, now what you just did in the class now. Okay, next. Overall weighted average cost after tax cost of additional finance, KD into debt mix, yes or no, plus KE into equity mix. So 5.7% into 30% plus 15% into 70%, you get 12.23%. This problem is clear. Everybody understood?
Yes, sir.
Yes,
Yes.
sir.
Simple.
Yes, sir.
Okay, next one. Capital structure of D Limited as on 31st March 23 is given below. Equity share capital rupees 10 each, 30 lakh. 8% preference share capital 100 each, 10 lakh. 12% rupees 100 each, 10 lakh. Okay, na? Current market price of equity share is 80 per share. The company is paid a dividend of 14.07 per share. That means now it is 14.07, correct? Next, 7 years ago, it paid a dividend of rupees 10 per share. Yes or no? So this will be D minus 7. That is 7 years ago, it is rupees 10 per share. Okay. Next, the expected dividend, that is D1. D1 is rupees 16. Artha aita? All of you? Yes. So 7 years ago, it is 10. Why do you think this information is given?
Calculate good.
Calculate G.
Yes, to calculate G. Yes, to calculate G. So what is the formula? 14.7. Yes or no? It is 14.7, which is equals to 10 into 1 plus what is the growth rate to the power of 7? Yes or no?
Yes, sir.
14.07.
14.07.
Yes. So it will be what? 14.07. Okay. 14.07. So this will be very simple. 14.07 divided by 10. That is 1.407. Correct? 1.407. You should find out what is the 1 plus G to the power 7. If they would have given a table, check here. 1 point. So for 7. So future value 7. Yes or no? This is 7. For this is 7. Now you find out where is 1.407. Check this.
5%.
5%. Aste. Okay. Next. 8% preference shares are redeemable at 6% premium after 5 years. So first you need to calculate what is the preference dividend. Correct or not? And then it is redeemable. So it is a redemption. So irredeemable and redeemable preference shares. Yes or no? KP you have to find out. So this is redeemable. So it is redeemable at 6% premium. So how will you calculate this? What is the redemption value, guys? What is the redemption value?
106.
106.
106. Yes or no? Always, if they have not mentioned, it will be on face value. Yes or no? So on face value, calculate 6%. So the redemption value for this will be 106. Okay. Redemption value will be 106. Next, the current market price, this will be your net NP. This is what you will consider as a NP, current market price. So 106 minus 104 divided by number of years. Yes or no? Remember the formula. So PD, preference dividend, that is 8%. 8% of 100 is 8, correct? 8 plus 106 minus 104 divided by number of years, the whole divided by 106 plus 104 divided by 2. ಗೊತ್ತಾಗ್ತಾ ಇದೆಯಾ?
Yes, sir.
Yes or no? So anyway, we'll go through the question. I will go through the answer, but I'm already solving it by reading the question. 12% debentures are redeemable at 20% premium after 10 years. Again, premium on what? On 100 rupees? On this 100 rupees premium, correct? So it is redemption value of this is how much? Redemption value is equals to 120. Correct or not? And what is the net proceeds? If nothing is given, it will be your face value itself. Okay, now flotation cost is rupees 5. Flotation cost. So you have to minus this flotation cost of 5 per debenture. Okay. And then 12 interest you have to calculate and then give the effect of 40%. In order to finance an expansion plan, the company intends to borrow 15% long-term loan of rupees 30 lakhs from bank. This financial decision is expected to increase the dividend on equity from 16 per share. Yes, 16 it is going to increase it to 18 per share. Okay. However, the market price of the equity share is expected to decline from rupees 80 to 72 per share. Okay, because investors' required rate of return is based on current market conditions. Determine the existing weighted average cost of capital taking book value weights. Okay, then I think revise they will ask. Yes, after the expansion plan, again you need to find out what is the weighted average cost of capital. So now if you check here, 5% we found out already. Yes or no? 5%. Next, cost of equity, yes or no? D1 by P0 plus G, that is what? 16. Yes, D1 is 16, P0
Yes,
is 80 given in the question, G is 5%, so it is KE is 25%. Next, PD, remember this formula? This also I told. Yes, number of years is 5 here. So 8 plus 106 minus 104 divided by 5, hold this thing, you'll get 8%. Clear all of you?
Yes, sir.
Yes. Cost of debt is I into 1 minus T. This formula everybody knows. Yes or no? So this one, remember, this is 100 minus flotation cost of 5. 100 minus flotation cost, you get 95. 120 you got 100 into 120% because it is premium 20%. Okay, 120 10 years is the redemption period, maturity period. So interest rate is 12%. Face value is 100 into 12%. You get interest rate of 12 rupees. 40% is the tax rate. When you solve, you get 9.02%. Okay, now. So now, weighted average cost of capital, very simple. Find out the book value weights first. Okay, now. Equity share capital is 30 lakh, 10 lakh, and 10 lakh. Yes or no? Given in the question already. Don't think from where it is coming. It's already given. 30 lakh, 10 and 10. Okay. Yes. So same thing I'm taking it here. 30, 10 and 10, 60. So percentage wise, it is 60%, 20% and 20%. Multiply into the respective cost and then add. This is your weighted average cost of capital. Simple. Yes. Okay. This is don't follow this. Okay. Yes. Just follow one approach, that is enough. Next, cost of long-term debt. Yes. 15% they've given. So 1 minus 0.4. Sorry. This is the new one. Okay. New one here. Check here, 15% long-term debt they've given. Tax bracket is 40%. So 15% into 40% is the KD and the loan is 30 lakhs. Yes, the loan is 30 lakhs. Check here. 9%. Okay. After that, they're saying what? The dividend is increasing from 16 to 18 and market price is reducing from 80 to 72. Correct. Therefore, the new KE will be 18 divided by 72 plus 5%, that is 30%. Okay, now replace it. Now equity share capital is 30 lakhs itself. This is not changing, correct or not? This is not changing. Only thing is you're adding this is addition, long-term debt 30 lakh. So accordingly the weights will change. Here what is changing? Again, your equity share capital percentage is changing, correct? And long-term debt is adding a step. Where same, everything else is same. Multiply, you get weighted average cost of capital. Clear all of you?
Yes, sir.
Yes, sir.
Again, this is not required. Next, your RTP May 2023. Okay, Amrit Corporation has the following book value capital structure. Equity capital is given, that is 5 CR. Okay, 5. Then 15% preference shares, retained earnings, debentures of 14% and 13% loan. The company's last year earnings was rupees 5 and it maintains a dividend payout ratio of 60%. This is EPS, correct? The returns on equity is 10%. Okay. the market price per share is 20.8. So what all things they have given? EPS they have given, yes or no? EPS is 5, correct? Earnings per share. Your dividend payout ratio is how much? 60%. That means the retention ratio is 40%. I'm just writing information. Okay, now. Yes, retention ratio is 40%. Your returns on equity, they're given, yes or no? Returns on equity is 10%. Return on equity is 10%. And your market price given is how much? 20.8. Okay, now. Next. Preference shares are redeemable after 10 years. 10 years. And is currently selling at rupees 90 per share. Yes, so market price is 90. Debentures are redeemable after 6 years and currently selling at 75 per share. Income tax rate is 40%. Calculate weighted average cost of capital using market value weights. Yes, market value weights. Determine the margin cost of capital if it needs extra 5 CR next year, assuming the amount will be raised by 60% equity, 20% debt, and 20% retained earnings. Equity shares will fetch a net price of 14 and cost of debt will be 13% before tax up to 40 lakh, and beyond 40 lakh it will be 15% before tax. Okay. Yes. So first you have to find out the individual cost of capital. Yes or no? Specific cost. So what is the cost of equity? I told you D0 they've given. Yes. D0. Yes. What is D0? Yes. What is D0? Earnings per share is given. Yes or no? 5. Last year earnings is 5, then dividend payout ratio is 60. So therefore, can I say D0, that is EPS into dividend payout ratio 3, correct or not? Yes. Next, as soon as you see this, you should be able to get to know that growth rate you can calculate. Yes or no? That is what? B into R. G is equals to B into R. Yes. What is the rate of return they've given? 10%. Your retention rate is 40%. We have calculated, yes or no? 40%. So 40% into 10%, your growth rate is 4%. Your growth rate is 4%. So D1 again, same way. Yes, D1 is D0 into 1 plus G. That is D0 is 3, 4%, 3.12. So 3.12 divided by 20.8. Elinda Bantu, it's given in the question, correct or not? 20.8. Yes, 3.12 divided by 20.8 plus 4% is 19%. I hope this is clear.
Yes, sir.
Yes, sir.
Calculation of cost of preference shares. N is 10 years. They have given in the question. Net proceeds is 90. Again, market price per share is given. Preference dividend, it is check here. 15% preference shares of rupees 100 each. So on that, obviously the preference dividend will be rupees 15, and redemption value. Yes, redemption value, if nothing is given in the question, will be nothing but the face value, correct or not? Redemption value, if nothing is given, it is nothing but the face value. So redemption value is 100. Clear? So redemption value 100 minus net proceeds by N. The whole here 2 missing is divided by 2. Divided by 2. Okay. So 15 plus 100 minus 90 by 10. 100 plus 90 by 2 into 100. Solve for it. You will get 16.84. I hope you understood this. How to solve. Okay. Now, when you're reading, you'll read like how I'm doing now, or you solve.
We will solve, sir.
Yes, you assuming that you are going to solve. I'm only clearing the concepts here. Okay, so that you can solve it faster and cover more and more problems. I hope it is helping. Yes or no? Okay. Next, calculation of cost of debentures. Again, this is given redeemable after 6 years. Net proceeds is 75. Check here. Yes. After 6 years, currently selling for 75 per share, correct or not? So it is net proceeds, what you take is 75. And I told you redemption value, if nothing is given, you will consider what? You will consider nothing but the face value, that is 100, and tax percentage is 40%. Again, calculate for KD using the formula, you get 14.37%. Cost of term loan is interest rate into 1 minus T. So 13% into 1 minus 4, it is 7.8 using market value rates. Very important. Now you see, observe here, that is why there is no retained earnings here. No retained earnings. Yes or no? Because equity includes it. Equity includes it. Correct. So market price per share 20.8, 90 and 75 into the respective number of shares, which is already given. Check here. Yes, 50,000 shares, 50 lakh shares and 2,50,000. Correct. Same things have come here. Okay. Multiply. You get the total market values. For term loan, what is the market value? It's nothing but the book value. For term loan, market value is nothing but the book value. So you take the book value and then find out the market value rates, multiply into the respective cost of capital, what we just found out, you get the weighted average cost of capital. Okay. Calculation of marginal cost of capital. The required capital is 50. Will be raised as follows. Equity is 60%. That is 30 million and then 10 million equity and debt. Retained earnings is 10. Okay, now it's given in the question. Therefore, marginal cost of equity. What is margin? Your dividend, is it going to change? Your dividend will not change, yes or no? Your D1 is the same. However, your market price is changing. Your market price, if you observe here, it is changing. Your net price, once this new 5 CR, whatever this is, 5 crores, something is taken, it will become 14. Artha it is becoming 14 from the existing market price of 20.8. It is reducing and becoming 14. So KE, your revised KE will be what? Yes. So D1, it's 14 ido. 1.4 alla. 14. 3.12 divided by 14 plus G of 0.04, you get 26.28%. Okay, now? Yes. And then you use marginal cost of debt again. Up to 40 lakh is 13%. Beyond 40 lakh is 15%. So find out what is the total cost of debt using the ratio, ratios and proportions. You get 14.2%. And then after tax is 8.52. Again, calculate based on based on the marginal cost of capital weights. You find out what is the weights is given. Cost of capital we have found out. For reserves it is same. Yes or no? Check here now. Determine the marginal cost of capital if it needs retained earnings and this. So it is all given here. So that is why, since here market value is not mentioned, yes, using market value proportions is not mentioned, they have used the book values itself. Okay, now, yes, 22.73%. 22.73%. Next. Following the extract of balance sheet of Messrs. KD Limited. Okay. Ordinary shares, all of you listen. Ordinary shares of face value of rupees 10 per share. Share premium is given. Retained profits 12%, 8% preference shares and 12% debentures. Ordinarily shares are currently priced at this. Remember this ex dividend and cum dividend problem. Yes or no? 39 ex dividend and preference shares is priced at 18 cum dividend. Yes. The debentures are selling at 120% ex interest. The applicable tax rate of KD Limited is 30%. KD Limited's cost of equity has been estimated at 19%. Okay. So KE is what? 19%. Calculate the weighted average cost of capital of KD Limited on the basis of market value. On the basis of market value. How will you get find out? Now let us see. Computation of weighted average cost of capital on the basis of market value. Working on number 1. Cum dividend price of preference shares is how much? 18 given here. 18 cum dividend. So from that you have to minus the dividend. Yes or no?
Yes,
less dividend. Less dividend. Where is it? 8% preference shares with a face value of rupees 25 per share. So 8% of 25, 2 rupees you have to remove, and therefore market price of preference shares is 16. Did you understand this? Yes. Next, number of preference shares. You have to find out what is the number of preference shares. Here, 4 lakh divided by 25. Simple. Yes, 16,000. Okay. KP is very simple. That I didn't. So that is preference dividend divided by market price is nothing but your cost of preference shares. Working on number 2. Market price of debentures. You have to find out. Yes. Check here now. 12% debentures face value of rupees 100 each of 6 lakhs. Okay. 6 lakhs is given. And then here, debentures are selling at 120% ex interest. Are selling at 120% ex interest. So using that information, 120% of your current face value. Yes, here, 120% of the current face value, you get rupees 120. Okay, now. Yes. So your interest is 12 rupees because 12% of 100, 12% of 100, 12 rupees. Are you all understanding?
Yes, sir.
Yes, sir.
Okay. So 12 rupees into 1 minus T divided by your market price that you just found out, you get 7%. Okay. Yes. Again, number of shares is simple. Now value divided by face value. Yes. the book value divided by face value, you get the number of debentures. Number of debentures. Market price of equity shares rupees 39. Yes. Given in the question here, ex dividend. Since it's ex dividend, any adjustment required?
No,
Not
sir.
required. Okay. So 39 is already given. KE is also given. Remember? Yes. I written here. KE is 19% given in the question. So that is also written here. So when you know the market price, you know the KE. Okay. Number of equity shares you can find out again. Book value divided by the face value. Book value divided by face value. Okay. So now you have to multiply. So market price of all is given. Yes. Preference shares and then debentures and equity shares multiply into the exact, specific, corresponding number of securities, whether it's equity shares, preference shares, or debentures. Find out the total market value, find out the weights, multiply the respective cost of capital. You get the weighted average cost of capital. Okay. Next. MR Limited is for having the following capital structure, which is considered to be optimum as on 31st March 22. Okay. Equity share capital, preference shares, and debentures. So this is your weights. The earnings per share of the company were 2.5 rupees in 2021. Okay. And the expected growth in equity dividend is 10% per year. So G is equals to 10% they've given. Okay, this is as on which date? MR Limited is having the following considered with the optimum as on 31st March 22. Artha this is as on 31st March 22. So the earnings per share of the company were 2.5 in 2021. Artha 2021. That is your previous year itself. It is 2021. Okay, next. The next year's dividend per share is 50% EPS of the year 2021. The current market price per share is 25. Okay. So dividend payout ratio is given. Current market price is given. The 15% new debentures can be issued by the company. The company's debentures are currently selling at 96 per share. Your market price is given here. The new 12% preference shares can be sold at a net price of 91.5. So this is again what? Your net proceeds. Okay. Face value is rupees 100 each. The applicable tax rate is 30%. After tax cost of new debt, new preference share capital, and equity share, assuming that the new equity shares can come from retained earnings, marginal cost of capital. How much can be spent for capital investment before? This is important adjustment. Yes or no? Important adjustment. Okay. How much can be spent for capital investment before sale of new equity shares, assuming that the retained earnings for the next year investment is 20%, 50% of 2021. Okay. Now, so now check here. Now, one by one we'll go. After tax cost of debt of new debt is what? I into 1 minus T by P1. I think that is very clear. Yes. Check here. What is the interest rate given? Yes. Interest rate 15% new debentures. Correct or not? 15% new debentures. So 15 into face value, that is 15% of 100 is 15 into tax rate is 30%. Market price is 96. I hope everybody is able to, connect. 10.94% is KD. KP is given PD by P0. Okay. Again, 31.11%. Again, all this directly picked from the question. Okay. They've not done anything much here. Okay, this is important. D1 by P0 plus G. D1 will be based on previous year EPS into 50%. Yes or no? D1 will be previous year EPS into 50%. So 2.5 into 50% divided by current market price at 25 plus growth rate of 10% already given 15%. Marginal cost of capital, proportions are given, specific cost into this, you'll get marginal cost of capital. Amount that can be spent for capital investment, mark this important. Retained earnings is equals to 50% of EPS into number of outstanding equity shares. Correct or not? That is my retained earnings. Yes, 50% of EPS is retained. No, yes or no? 50% is paid out as dividend, Madhubita. 50% is retained. So 50% of EPS into number of outstanding equity shares. You get 1.25 into 50, that's 62,500. Proportion of equity, that is retained earnings here, capital, is 80% of total capital. Therefore, 62,500 divided by 80% of total capital. Yes, what is the proportion? Check here, guys. This is what I'm trying to say. 80% alva. Udaita. Yes, from where that 80% came. Yes, so proportion of retained earnings capital is 80% of total capital. Therefore, 62,500 is retained, is the 80% of the total capital. Therefore, it is 78,125. 78,125. Did you all understand this? Yes. So in what ratio? Simple. Yes, I have done this in the class. Okay. How much can be spent for capital investment before sale of new equity shares? So in the same ratio, we have to follow, yes or no? In the same ratio, we have to follow this ratio, correct? We have to follow this ratio. That is how I get the total capital value. Artha aita? So after this only you will go with the new equity shares, etc. Clear, all of you?
Yes, sir.
Yes.
Yes.
RTP November 22. Bounce Limited evaluates its capital projects using discounting rate of 15%. Again, this is solved in the class. Okay. Bounce Limited evaluates its capital project using the discounting rate of 15%. Its capital structure consists of equity share capital, retained earnings, bank term loan, and debentures. Yes, equation. We have done an equation and solved this in the class. Again, this is important. Little different kind of problem. Okay. Yes. Rate of interest on bank term loan is 1.5 times that of debenture. Okay, na? It is 1.5 times that of debenture. Remaining tenure of debenture and bank loan is 3 years and 5 years respectively. Book value of equity capital, retained earnings, and bank loan is given. Okay. Debentures are having a book value of 15 lakh and are currently trading at 97 per debenture. The ongoing PE multiple for the shares of the company stands at 5. You are required to calculate the rate of interest. This is what we are to calculate on the bank loan and debentures if tax rate is 25%. So obviously we'll assume it to be X. We will assume it to be X. So let the rate of interest on debentures be X. Rate of interest on loan they've given here. Can you check here? It is 1.5 times, correct or not? It is 1.5 times. So it is 1.5X. Correct? 1.5X. So KD, cost of debentures, you know the formula. This is the formula. So now replace the values as step. Yes, face value. They've given all of this. Okay, 100 into 1 minus 0.25 tax rate, 100 minus 97 divided by 3. Hold, then add this and divide by 2. You get 1.125x. So if KD on bank loan is 1.5x into 1 minus 0.25, that is 1.125x. KE is what? MPS by EPS, that is price earnings ratio, yes or no? Using the price earnings, EPS by MPS, yes. So that is nothing but 1 by PE. Remember this formula?
Yes,
KE
sir.
is nothing but 1 divided by price earning ratio, yes or no? Why? Because what is KE? KE is nothing but earnings by P naught, yes or no? Earnings price approach, gutta. Earnings price approach, yes. Earnings by P naught, that is nothing but EPS by MPS, yes or no? So that is nothing but price divided by earnings, the inverse ratio, yes. So that is what they've used to find out the KE is. KE here. Clear, all of you?
Yes, sir.
Okay. So then for reserves, so if you observe here, for reserves and equity, the same cost is used. Same cost is used. Debentures though, 75x plus 1 into 75x plus 1. Here it is. Check here. Here 75x plus 1 divided by 98.5. Gotaita? Here 1.125x. Okay, is for bank loan. Use the multiply the weights and solve for the equation. Okay, why? Because weighted average cost of capital is given. Yes, that is why you can solve for the equation and find out what X is. There X is 10.36% andre 1.25 multiply madre, you will get bank loan. You will get bank loan. Did you understand the concept? Yes. Okay. May 22, question paper May 22. A company issues 15% convertible debentures of rupees 100 each at par with a maturity period of 6 years. Okay, na? At par it is issued. On maturity, each debenture will be converted into 2 equity shares of the company. Okay. The risk-free rate of return is 10%. Market risk premium is 18%. And beta of the company is 1.25. Why have they given beta?
CAPM method.
CAPM. Yes, the company has paid dividend of 12.676 per share. 5 years ago, that is D minus 5 dividend. It paid a dividend of rupees 10 per share. Correct. Now it is how much paying? Company has paid a dividend of D naught is equals to 12.76. Therefore, can you find out now easily? Yes.
Yes.
Okay. Next. Rotation cost is 5%. And then 5% preference shares of rupees 100 each at a premium of 10%. These shares are redeemable after 10 years at par. Flotation cost is 6% of the issue amount. Corporate tax rate is given. Calculate the cost of convertible debentures using approximation method. Use yield to maturity method. Yes, yield to maturity method to calculate cost of preference shares. Okay, now. Yes. So this thing. Second part I'll do later. Once you're after the break with full Josh you come, no, that time I'll do. Ivaga ಸ್ವಲ್ಪ down ಆಗ್ತಾ ಇದೀರಾ. I will do this part after the break. Full Josh al bani because I want you to concentrate. Because remember, I want to revise that entire equation the way I did IRR. Yes, the way I did IRR and all, I want to revise it. I'll do that. So first part, let us just go through. Okay, now calculation of cost of convertible debentures. This is convertible again. Little this convertible debentures the first time ಬರ್ತಾ ಇರೋದು. Okay, now so go through this once. Given that RF is equals to 10%, that is risk-free rate. Yes, risk-free rate is 10%. It should be small f. RM minus RF is 18%. Okay, beta 1.25. All this given in the question. D naught 12.76. D minus 5 is 10. Correct or not? Flotation cost is 5%. Therefore, using CAPM, you get RF is 10% plus 1.25 into RM minus RF is 18%. You get 32.5. Calculation of growth rate in dividend is 12.6. The 76 is equals to 10 into 1 plus G whole to the power 5, 1.276 to a 12.6 divided 76 divided by 10, 1.276. Can you find it here? Yes, 1.276 is 5%. Correct or not? Yes, it is 5%. So growth rate is 5%. Okay, next. Price of share after 6 years is D7 divided by KE minus G. Correct or not? Yes. So 12.76 into 1.075 whole to the power 7 divided by KE is what? 32.5. Yes, 32.5 minus G. Hey, MPS, idu KE formula only. They've just changed the equation. KE is what? Tell me what is KE formula? What is KE formula? D1 divided by P naught plus G. Yes or no? D1 divided by P naught plus G. What is the current year? What is the current year dividend? 12.76. Yes, 12.76. P naught. What is the starting price? P naught. This is what is the we don't know. Correct? Question mark. Plus G is how much? G is how much?
5%.
5%. What is KE? KE we just found out. 32.5. So 32.5%. Yes, 32.5. Now, so if I do this, what I get P naught. That is the current market price. Yes or no? I get the current market price. Adunne they have found out for P6 and aste. What is this P7, P6 and all? Okay, see. One second. Namatte torstini question. Check here. Maturity period of 6 years, correct or not? It has a maturity period of 6 years. And each debenture will be converted into 2 equity shares of the company. The risk-free rate is 10%, market risk premium is 18%, and beta of the company is 1.25. The company has paid a dividend of 12.76 per share 5 years ago, and now it is 10 per share. So the flotation cost is 5% of the issue amount. Yes. So what are we trying to find out? What is the redemption value? Artha agta idya? We're trying to find out what is the redemption value when it is getting redeemed. When is it getting redeemed? After how many years? Check here.
Yes,
Check here.
yes.
6 years. Correct. It is getting redeemed at 6 years, yes or no? So 6 years if I have to find out what is the price for 6 years. So assume 6 to be now. Assume you are in the 6th year. Assume you are in the 6th year. So that means what would be the formula for KE that you normally follow? If you are in the 6th year, you would want D1. D1 andre +1 agutta illi. Correct or not? D1 will become +1. If you are in the 6th year now, D1 will be +1. So that's why it will become D7. Gottaita? That's why it becomes D7. And that is how this D7 has come here. Because we need to find out what is P6, and this is nothing but my redemption value. Again, solve this problem. Okay, solve this problem. I think a convertible debentures, do solve it once. Okay, P6, we need to find out what is the redemption value as on P6, 6th year end. For that, I go 1 year ahead again and find out what is the dividend at that time. Yes. So how am I getting this 1.05 to the power 7? Because D0 is equals to 12.76. Correct or not? So after 7 years at a growth rate of 1.5%, what will be my dividend? That is nothing but D7. Correct or not? Yes. So that is D7 divided by KE minus G. You know this? There's nothing but this formula. Aste. Idana reciprocate madi. P1 will go here and this will come in the denominator KE minus G. Gotaita? Yes. So the same formula that is used, and I have taught this in the class also. Okay, go through your class notes once. That's what D says. So this is important to understand why P6 has come. P6 is my redemption value. Clear, all of you? Is there any doubts? Any doubts in this? Why P6? Okay, Harshita, clear?
Sir. Yes. Sir.
Yes. So P6 is 65.28 using the formula you get it. So redemption value will be twice. Okay, redemption why 2 times? Anybody? Why is this 2 here? Because they're saying 2 equity shares, right? You're getting 2 equity shares. So into 2, Arthaita.
Yes,
Into 2
sir.
we are doing.
Yes,
And that is
sir.
130.56. This is my actual redemption value. So 130.56 minus current market price is 95 divided by 6 years of maturity. And then 130.56 divided by plus 95 by 2. You use the equation and solve the equation. You get 13.24%. Okay. Preference share is easy. 100 into 1.1 minus 600, 6% of 100 into 1.1. Net proceeds is then flotation cost. Yes or no? I'm finding out what is the flotation cost. Currently, it is 100. Check here, guys.
Yes, sir.
10% preference shares of ₹100 each at a premium of 10%, correct? At a premium of 10%. These shares are redeemable after 10 years at par. Flotation cost is 6% of the issue amount. Okay, flotation cost is 6% of the issue amount, and that is why they're finding out what is the flotation cost a step. Next, redemption value is 100. Net proceeds is what? 103.40. Find out what is this is the second part. Okay, fine. This I think I'll do. I told you I want to do it later. Okay. After break, remind me immediately. First thing we'll start with this and then we'll move to the next chapter. Okay, now?
Okay, sir.
Yes. Next. Following the information relating to book value and market value weights of X Limited is given below. Book values are given, market values are given, equity share is given, quoted at 125 per share. Again, similar problem it is. Okay, this is similar problem. You guys can solve it on your own. Okay.
Yes, sir.
Same thing. Whatever we discussed so far. Similar type of problem. Yes. So again, different sources of finance are given. Currently, the market value of debentures is 110 per share. Equity share is 180. Expected rate of return to equity shareholders 24% per annum. Company is paying tax at 30%. Calculate based on market value weights here. Okay, market value weights and will you calculate for this separately? This you will not do separately. Clear? See here, equity shares only, right? No debentures. However, this one solve it once because they have solved it 2 times. Okay, why? I done it in the class also. I'd gone through this question. Now see here, 12%, 6%, 12%, 6,000 debentures at ₹100 each. right? So what we normally do, we take the after-tax cost of capital, correct or not? 12 into 1 minus 0.3, you get 8.4%. Yes, this is what we have done here, 8.4%. And then cost of equity is what? Yes, cost of equity, the expected rate of return to equity shareholder is 24% per annum. Company is paying tax at 30%. So that 24 directly we have taken here, correct or not? Yes. Market value, therefore told you to find out based on market value. So market value, how have they done? Take 6,000 debentures, market value is how much? 110. Yes or no? This 110, right? So that is what is taken here, 110. 6,000 into 110. Here 4,500 shares. How 4,500? Given here 4,500 shares into the current market price given in the question is 180. Correct? That 180 only has come here. Clear? 180, 4,500 into 180. You got market value, you got the weights, you multiply, you get weighted average cost of capital. Correct or not? Yes. But however, that is why they have given you two interpretations here and given it like this. Okay, calculation of cost of capital for each source of capital considering market value of capital. What they're doing is they're finding out KE and KD also using the market price. Yes or no? See, technically, what they're doing is they're assuming that this expected rate of return to equity shareholders of 24% per annum. Yes, 24% per annum. How do you calculate? So they've taken that on the face value 24%. See, it is all on interpretation, guys. It is based on the interpretation that return is on the face value or on the actual expected return on the based on the market price. Because obviously the formula you all know, it is D1 by P naught and earnings by P naught. Yes or no? It has to be on market price. So if you assume that 24% is on 100 rupees and this 12 or interest is also on the face value, not on the net proceeds, then you need to compute it separately.
Yes, sir.
Yes. If you assume that, see here, what are they given here? 12%, 6,000 debentures at rupees 100 each. So this 12% is calculated on this 100 alva. This 12% is calculated on that 100. So how can it be? How can you directly take 12%? So that is why how they have calculated is like this. I into 1 minus T by net proceeds of 110. Did you all understand? Yes. So that is why cost of capital is calculated again. And they say, right, that is how this is found out. Clear, all of you? Yes. I think this is also simple. You guys can go through. Yes. So this is the problem I've solved in the class. Similar or almost same problem with little bit different numbers I've solved in the class. Here what is happening is cost of debt to 3 different slabs you're having, guys. Okay. That is where you need to be careful. Okay. Cost of debt, 3 different slabs are there. So what you have to use, that is what you have to understand. The first one is, this is the important working note, pattern of finance for additional requirement. Okay. What is the additional requirement? Requirement of additional finance is 30 lakhs. Debt equity ratio is 2:1. So always remember 30 lakhs you take, then find out what is the debt, what is equity. Okay. For debt, then you find out what is the interest rate for different slabs. That is 10%, 9%, and 8%. Alle in the proportionate you multiply and find out what is KD. Did you understand? Yes. This is how you need to calculate KD. So if you check here, that's what they've done. Yes, debt equity ratio multiply 10 lakh and 12 lakh. And then the same chart what I did, they've done a table format here. Yes, for 10%, 9%, and 8% total. This is the thing. This is the only thing. You get this properly, then almost entire thing is same. Then all same, equations. Yes or no? Then all same equations. That's it. Okay. All right. So I think we'll go through the theory. Theory go through Mana. After that, we'll take break. Theory for 15 minutes of capital structure. Capital structure theories we'll go through now. After that, we'll take a small break. Come back. We'll do IRR, and then or probably we'll do the problem first and then do IRR, whatever. Okay, now.
Yes, sir.
Yes. So open the theory of capital structure theories. Capital structure. Page number ready?
Page number 18.
18.
PDF ಒಂದು ಸ್ವಲ್ಪ ಆ ಕಡೆ ಕೊಡಿ.
Yes. Capital structure. What is important? Yes. Now, first of all, now what did we learn? We just learned what is the cost of capital. Yes or no? How do I calculate the cost of capital for each source of finance? Any videos all off ಆಗ್ತಾ ಇದೆ. Keep it on. Yes. All right. Yes. So we find out what is the cost of capital for each source of finance. Correct. And then we found out what is the weighted average cost of capital. Correct or not? But we didn't understand. In this, whenever we were doing this problem of cost of capital, the source of finance was already given, the ratios are already given, correct? But in what ratio should I procure which source of finance? That is nothing but your capital structure. Yes or no? What should be my combination of capital? In cost of capital, till now, debt equity ratio already given. How much is the debt? How much is equity? In the previous one of the problem, we gave 30% was debt, 70% was equity. But how did you arrive at that 30% and 70%? In what way should you structure your capital such that, what is the most important? Your weighted, your KO, that is your overall cost of, no, you should structure your cost of capital in such a way, overall cost of capital is least. Yes or no? Why? Because when KO is less, what is more? Anybody? When KO is less, what will increase? Value of the firm. Yes or no? Correct? When KO is the least, value of the firm will increase. Correct or not? Value of the firm will increase. And ultimately, what is the objective? What is the major objective? Wealth maximization. Correct or not? Wealth maximization. So therefore, we should ensure that the KO is least and then the value of the firm is maximum. That is entirely your capital structure chapter. That is nothing but your capital structure chapter. So with that introduction, now let us go through this revision material. It is a combination of, it is the combination of capital, basically your debt and equity from different sources of finance. That refers to the combination of debt and equity. Optimal capital structure. What is optimal capital structure? It is that where the value is maximum. Capital structure where the value is maximum is called as optimal capital structure. It is that mix of debt and equity where KO is minimum. Yes or no? And therefore value is maximum. An optimum capital structure is a financial plan having an appropriate debt equity mix which minimizes the overall cost of capital and maximizes the shareholders' wealth. And maximizes the shareholders' wealth. Do you all understand? Yes. So you have different capital structure theories, okay, relevance theories, then others and irrelevance theories. What are relevance theories? They say that capital structure decisions are relevant. Yes or no? Relevance theories means capital structure decisions are relevant. That means depending on the capital structure decision that you have taken, it will impact the value of the firm. Yes or no? It will impact the value of the firm. That means it's relevant. Irrelevance theory means irrespective of what is the decision you take, how much ever is the debt, how much ever the equity, doesn't matter. At the end of the day, the value of the firm will be same. Did you all understand? That is the difference between relevance and irrelevance theories. Okay. Next. So under that we learned net income approach, then your net operating income approach, traditional approach, MM model without tax, then MM model with tax, and others are small ones, that is pecking order theory and trade-off theory. In net income approach, then net operating income approach, traditional approach, and MM model without tax, it has a no tax assumption. Yes or no? So entire model is based on the assumption that there is no tax present. Correct or not? Which is not practical. Because in real life, tax is present maybe in 1 or 2 countries where there is no tax. There those theories might be more relevant, but however we are learning from a theoretical perspective. Yes. Fifth one, that is MM model with tax, is the only theory where tax is present. Okay. What are the assumptions? The only 2 sources of capital are debt and equity. Total capital employed remains constant. Yes, increase in equity will be used to redeem debts and vice versa. That is why the total capital is constant. EBIT remains constant. There are no corporate taxes or no transaction cost. Okay, no growth. Therefore, annuity formula A by I is followed. A by I. Yes, Because there's no growth. A by I is what? For example, in my KE formula, D1 by P naught plus G. If there is no growth, then what is the formula? Dividend price approach formula was D1 by P naught. Yes or no? Same way here also, the following A by I approach. Yes, what is that? You'll get to know later. Okay, now there are no retained earnings. Entire profits are paid as dividend. Therefore, dividend payout ratio is 100%. Okay, therefore, dividend payout ratio is 100%. Perpetual life. It has a perpetual life. Business risk is constant. See, why no retained earnings? Because there is no retained earnings, there is no growth. Because there is no retained earnings, there is no growth. What is the growth formula? B into R? Yes or no? B into R. Retention illa andre growth engagutte. Correct or not? That is why assumption is that there is no growth, and assumption is dividend is completely paid out. So for all of these approaches, the formula is like this. Yes, value of firm is what? EBIT or net operating income. EBIT or net operating income divided by KO, overall cost of capital. That is the value of the firm. Yes or no? Your profits divided by cost will give you the value. Yes, or in other words, your cost of overall capital, is nothing but net operating income available to both debt as well as equity. Available to both debt as well as equity. That is my net operating income, or EBIT, earnings before interest and tax, divided by value of the firm. Same way, value of equity is what? Net income. This is what? That is my profit after tax or earnings after tax. Yes or no? Correct. After tax, what is available? That is my net income divided by KE. But in this case, since tax is not present, what will I call? It is nothing but my EBT. Yes or no? Earnings before tax. Correct. That is nothing but after the payout to the interest. That is EBIT minus interest is nothing but my net income. Correct or not? Net income. And KE is NI by S. Okay. And debt is nothing but value of the firm minus S. That is your debt. Yes. Or interest divided by KE, or KD is equals to interest by D. These are the formulas. Okay. Value is value of equity. So value of the firm is equals to S plus T. That is value of equity plus value of debt. Now, the first approach, that is your net income approach, all of you concentrate. According to this theory, the capital structure of the firm affects the value. Therefore, it is relevant. Yes or no? It is relevant in nature. If the financial leverage of the firm increases, yes. If the financial leverage, now check this. Financial leverage of the firm increases. This is the leverage. Yes, all of you are able to see the chart? Leverage, yes, financial leverage. What do I mean by financial leverage? Yes, that means I'm taking more and more debt. That is my weight of the debt increasing. The weight of the debt is increasing. The leverage is increasing. Yes. So with more and more debt coming into picture, what is happening to my KO? My KO is coming down. Why? Because it assumes that KE will be constant and KD will be constant. So when KD is constant, when KE is constant, weight is increasing of the debt. Weight of the KE is coming down. Yes or no? Because the total capital is constant. Yes or no? You saw the your assumption here. Yes. The total capital remains constant. Okay, total capital employed remains constant. Yes, total capital employed remains constant. So you're just replacing your equity with the debt. Okay, KE is normally more or less than KD. KE is normally more than less than KD. Yes, KE is more. So risk is more. Yes or no? Risk is more. So naturally, when the weight of KE will come down and weight of KD goes up, KO has to come down. Yes, KO has to come down. So that is what is happening here. So if you check here, your KO reduces with the increase in debt. However, KD and KE is constant. This is your net income approach. So if you remember, this is the most, I will not use the word that I used in the class to be more sophisticated, or no sophisticated alla, to be more diplomatic. I'll use it. It's the most unrealistic asaku alva. Class had the word name nenpide. Okay, it is the most unrealistic. Yes or no? Public YouTube. Matte yaro or madiron matte one nan mel case agbitre his ancestors and all his what heirs, they come put a case on me. I don't want a case. Yes, it is the most unrealistic. It is the most unrealistic. Yes or no? Why? Because tell me why? Because with the increase in value of debt, your risk as an equity shareholder, are you happy if the debt keeps on increasing? Are you happy? Tomorrow, it's Yes, you're obviously not. So obviously with your increase in risk, what is happening? Your risk is increasing. Your return also will increase. Expected return. That is why I said your cost of capital is basically the return expected by the holders of capital and not what the company is actually paying. Yes or no? Correct? And not what the company is actually paying. That is why this is most unrealistic. Correct? And therefore, this is the most that is why it comes the introduction to the next topic, that is net operating income approach. This is the second one. Yes or no? This is the second approach, number 2. Here, this is like a paradise type. Yes or no? Like a paradise, or in a dream world it is real, not in real life. Yes or no? What does it say? Yes, what does it say? Check the chart now. Very simple. That with the increase in debt, naturally KE will keep increasing. Yes, because your risk is increasing, but KD is remaining constant. Yes or no? So the increase of KE increase after yes or no? KE is increasing. However, weight of KE, is it increasing or reducing? Weight of the KE, is it increasing or reducing? Weight is coming down. Why? Because weight of KD is going up, correct or not?
Yes,
so
sir.
what it says is, in this net income approach, when KD was constant and weight was increasing, it was reducing the KO because KD is normally lesser than KE. Yes or no? KD,
Yes.
cost of debt, is normally lesser than cost of equity, correct or not? Yes. So with the increase in debt, overall cost of capital should come down. However, KE is increasing because of the risk. They're saying this force will cancel out each other and KO will remain constant. Artha both the forces will cancel out each other and therefore KO will remain constant. I hope everybody understood. Yes. So now you check the theory. Yes. According to this theory, the value of the firm is unaffected by capital structure. Correct. That is why KO is remaining constant. Irrespective of the debt equity ratio, Naman, your KO is constant. Correct.
Yes, sir.
KO is constant. Therefore, it is irrelevant. Whatever may be the degree of leverage, the total value of the firm remains constant. If the financial leverage of the firm increases, weighted average cost of capital remains constant. Okay. Value of the firm will remain constant. Market price of equity share remains constant. Equity shareholders are exposed to more financial risk. They're exposed to more financial risk with the increase in debt. But since debt, which is a cheaper source of finance, increases, the increase in KE is set off by the decreases in KD. Artha aita? This is important formula. Yes. Important. KE is nothing but KO plus your debt equity ratio into KO minus KD. Artha aita? Yes. Debt by equity into KO minus KD. That is my KO. Next. Assumptions of the theory is same, all of this. Okay. Next one, traditional approach. Okay. As an unlevered firm goes for KD debt, KD and KE remains same. Yes or no? So initially, basically it says this, that up to a certain stage, with the increase in weights of debt, KE will remain constant. Up to a certain extent, with the increase in the weights of debt, yes, KE will remain constant. KD also will remain constant, and therefore KO will come down. Yes. If KE is constant, KD is constant, but weight of KD is increasing. Don't you think it is nothing but first half of it is nothing but your net income approach logic?
Yes,
your
sir.
first half. Yes, not first half means initial stage. But however, what it says is, as and when weights increase beyond a certain level, when the weight of debt increases, your KD also increases to some extent, because risk is increasing even for the bankers, alva. Risk is increasing even for the bankers. So therefore, KD also increases to some extent. KE, because your risk is increasing, that also increases to some extent. Okay. So therefore, the graph will be, to some extent, you will see it doesn't increase, but after beyond a level, even KD is increasing, correct? It is increasing here. KE is also increasing. Up to certain level, it is constant. After that, it starts increasing. So then your value of the firm, first it will come down and then it will start going up. This point is the optimal capital structure, debt equity. Godaita? That is my traditional approach. This is the most realistic. However, what's the problem with this? It does not define the manner of computation of what should be my debt equity ratio, alva. It doesn't say how do I compute the debt equity ratio. It's only giving a theory that it will increase, but at what point it increases, that's not given. Did you understand? At what point the KD and KE will increase is not given. Therefore, theoretically, this is correct. Based on past data only, you can find out a step. But whether it past data, in mutual funds, you've heard, no? You've heard that terms and conditions, right? Past performance cannot be relied upon for the future performance. And Adhe tara, we cannot rely on the past performance, future performance. They've not defined as such. Only theory is given. So, next one. approach, Modi, Glani and Miller approach without tax 1958. According to this approach, two companies which have the same business risk and same capital employed with the same operating profit should have same market value. Arthaita? So this is, but if you remember, it is nothing but net operating income approach. Yes, because in net operating income approach also, what does it say? Irrespective of the debt equity structure, your value of the firm will be same. Yes or no? That's what Modi, Glani and Miller also is saying. Approach is also saying the same thing, that irrespective of your debt equity, it will have the same market value as long as they're of the same risk class. As long as they're of the same risk class. It is similar to NOI approach. However, it provides a more behavioral justification. Why? Because markets follow the arbitrage process. Check, what is arbitrage process? It's the process by which similar product having different prices in different markets at the same time are brought to equilibrium. Correct or not? So if there is gold into markets, yes, in one market the price is lesser than the other, all of them will start shifting to the other market where it is lesser. Yes or no? So yes, then what is happening? The demand in the other market, say there is market A and B, all of you keep your videos on. Yes, there is market A and B. Okay, market A only value is lesser for gold. In market B, the value is higher. Yes or no? So from market B, everyone will start moving to market A. Right? In market A, when the demand is increasing, price will increase. In market B, when demand is decreasing, price will come down. In one place it increases, other place it comes down in such a way that an equilibrium is formed, and that is called as your arbitrage process. Clear? So that is how he is justifying why your debt equity structure doesn't matter. Yes, the debt equity structure doesn't matter. How it doesn't matter, that is what is shown here. Yes, so that is why according to him also, without tax model only, under the without tax model, this is irrelevant. Okay, irrelevant. So I want you have to go through your class notes for the steps. Okay, step 1, 2, 3, 4 for 4 different approaches. So first, Roman number 1 AB, Roman number 2 AB are given. Yes or no? For that you should know your class notes. Here summary is given. Yes, from levered to unlevered when you're moving. That is, when you move from levered from to unlevered from, when the value of the levered firm, yes, when value of the levered firm is lesser or greater than value of unlevered firm. Now in market A and market B approach, in market A, the price of the gold was lesser. In market A, the price of the gold was lesser. Yes or no?
Yes, sir.
In market B, the price of the gold was higher. So everybody moved from market B to market A. Correct or not? Same way, now you think, if everybody is moving from levered to unlevered, everybody is moving from levered to unlevered. So obviously, value of this is more than this. So this you are getting at a lesser price. Yes or no? You're getting at a lesser price. See, inherent value is the same, guys. Artha madkoli. Market value is determined by market forces. Yes or no? By demand and supply. But inherent value of the asset is same. Numbers of both are same. So why did you all move from market B to market A if market A was giving lesser price for gold? Because you know that the gold value is the same, alba. Inherent value of the gold is same. Yes, inherent value of the gold is same. That is why you're all rushing towards this, because you're getting at a cheaper price. Yes or no? Same way, VL and VU, you should imagine like that only. There are two companies with inherent value to be same. That is what is the theory saying. Modiglani MM approach is saying that they have to be same because they have the structure like that. They have the same risk class, they have the same capital employed. The value should be same, but however, because of market forces or whatever reason, the value is different. So you will start selling the one with the higher price and you'll go start moving the one with the lower price. So that is why when you move from a levered firm to an unlevered firm, when you move
Yes,
from
sir.
a levered firm to an unlevered firm, levered firm only, there is equity as well as debt, correct or not? That's why it's called levered. When there is debt present, you call it as levered. When you move from equity to levered to unlevered, in an unlevered firm, there is no debt for you to invest. There is no debt for you to invest, yes or no? When
Yes,
you're
sir.
selling, you obviously will sell both equity and debt. You sell of the levered firm, you sell both equity. Yes, so sorry, equity and debt, Andre. Understand? Okay, see this.
Yes, sir.
You have a levered firm here. Yes, you own 10% of it, correct or not? But there is debt also present. You may not own the debt, but since you're a 10% equity shareholder, indirectly your risk is connected with the debt that the company owns because you own that company, yes or no? So therefore, to make sure that the risk is same, risk should be same, then only arbitrage process works. So that's why what we do, we take 10% equity if we sell in VL, 10% personal debt is borrowed. 10% personal debt is also borrowed, and then this amount you invest in unlevered firm, right? So you take 10% the equity you sell, then debt also you borrow, correct? What is 10% personal debt? Yes, of the debt that is already existing in VL. Artha madkodi. See, if levered firm has 100 equity, and if you're selling 10, if 10% is sold here, and if it has say 10 debt, then you borrow 10% of the debt. Did you understand? Yes.
Yes, sir.
So that is how you do. So you take 10% equity, you sell, 10% personal debt is borrowed, you invest in an unlevered firm. Okay, there are two approaches now. Increase in income approach, that means you invest the entire amount in the unlevered firm, right? Increase in savings and investment approach, then what you do, you do not invest the entire amount, you only own 10% of the unlevered firm. You only earn 10% of the unlevered firm, such that later on, when you own 10% of VU, your earnings is same because EBIT is same, yes or no? EBIT of both is same, correct or not? Your earnings before interest and tax, because they're of the same value, it will be same. So your earnings is then remaining same. Then your savings on the investment comes into picture. When we go through one or two problems, you will understand better. Okay, now I hope you're able to recall whatever we've
Yes,
discussed in the
sir.
class.
Yes,
Okay.
sir.
So from an unlevered firm to levered firm, there is no debt here, correct or not? There is no debt in an unlevered firm. So 10% of the equity you sell, 10% the equity you sell and invest in levered. See, this 10% is an assumption. If the question mentions a certain percentage, then go with that percentage. Clear? Question mentions a certain percentage, go with that percentage. Nothing is mentioned in the question. Assume 10% and do it. Invest in levered firm, correct? Increase in income approach, you invest the entire amount. Increase in savings and investment approach, you invest 10% in the total value, that is debt plus equity. Invest in the total value, that is debt plus equity. I hope I'm clear.
Yes, sir.
Yes.
Yes, sir.
So MM model with tax, you have when there is tax, there is tax shield present, correct or not? If tax shield is present, then he's saying because of tax shield, the value of the levered firm will be more than value of unlevered firm. Correct? Value of levered firm will be more than value of unlevered firm, such that the difference is nothing but your tax advantage on debt. Your tax advantage on debt, yes or no? Correct. Your tax shield. In the presence of tax, debt financing is preferred as interest on debt is tax deductible, and therefore value of levered firm is more than value of unlevered firm. Value of debt is 100 lakh. Value of debt is 100. These are all assumptions. Okay. Tax rate is 20%. Interest is 10% on this 100 lakh. Correct. So it is 2 lakh. 2 lakh. What is the tax? What is the tax on this into? So value of debt is 100 lakh, interest rate is 10%, and then 20% of that is the tax rate. So interest tax shield you check here, 100 lakh into 10% into 20%. Interest tax shield is 2 lakh. Did you all understand this? On 100 lakh, you get a 10% interest, on that a 20% tax shield. So this is my advantage or savings, yes or no? This is my advantage or savings. This will happen year on year, correct or not? This will happen year on year. So can I say this is nothing but present value of tax shield, present value of interest tax shield, correct? Present value of interest tax shield. Annuity formula is what? A by I, annuity formula. So 2 lakh divided by I in this case is your tax rate. Yes or no? Tax rate. So 2 by I, sorry, your interest rate. Your interest rate is 10%, correct? Interest rate is 10%. So 2 lakh by 10%, that is nothing but 20 lakh. Or in other words, very simple way to calculate it. What is equal to 20 lakh? If you observe here, 100 lakh into 20%. So the other formula for tax advantage on debt is nothing but debt into tax rate. Into tax rate. That is your tax advantage on debt. Value of levered plus is a firm is nothing but value of unlevered firm plus DT. Okay. When a levered firm is asked to be valued using model with tax, then follow the below steps. Okay, one by one. Step 1, assume that the firm is unlevered first. Even though it is levered, yes, you first assume it to be unlevered. Find out that and then add the tax advantage on debt. Did you understand? Yes. So value of unlevered firm. See, if there is no debt, assume that it is no debt, correct or not? If there is no debt, and if there is no tax rate, if there is no tax rate, that is tax is 0, then VL is equals to VU, yes or no?
Yes, sir.
VL is equals to VU. So find out what is the value of the unlevered firm first, right? So now this you have to understand. Value of unlevered firm, the KE irutte, correct? KE irutte, yes or no? KE. This I call it as KEU. KEU, that is cost of equity of the unlevered firm, wherein debt is 0. Arthaita, debt is 0. In such a case, KO of VL, can I say, is equals to KEU, yes or no? Because overall cost of capital of both the firms, VL is equals to VU, andre KO of both should be same. Since there is no debt here, for unlevered firm, KO is equals to KE. Correct? For unlevered firm, if there is no debt, KO is equals to KE, yes or no?
Yes, sir.
Yes, sir. Yes.
To KE. So therefore, what we do, value of levered firm. First, you find out value of unlevered firm, that is EBIT into 1 minus T divided by KO star or KEU. Okay, na? KEU, right? And then tax advantage on debt, you take D into T, add both the steps, you get what is VL. Clear? Then find out what is the overall cost of capital of the levered firm, that is EBIT into 1 minus T divided by VL. That is the overall cost of capital. And then KE of the levered firm is profit after tax or net income. Yes or no? Net income, but after tax. After tax, that you divide by value of equity, you get KE of the levered firm. Yes. Also, you can follow this formula, KO plus KO minus KD by D by S into 1 minus T. Okay. Next, pecking order theory. Basis, actually, this is why basically, how does it work? Based on information asymmetry. Remember, information asymmetry. That means information is not easily available to everybody. The insiders of the company have more information when compared to the outsiders, correct or not? Insiders have more information when compared to the outsiders. So that is why it says pecking order of financing. First, they go with retained earnings. Yes, retained earnings. And then if you go with debt, what happens? It's giving a positive signal. Yes, to the stakeholders, saying that it shows confidence that I'm able to raise debt from the market. That means I'm confident in the project. Yes or no? If you're not confident in the project, will you have the confidence to, take debt? Obviously not. So that is why the next is this. And last one is the external equity, because equity shareholders, they'll be like, why are you coming to us? That means, don't you have the confidence to take debt? So last option will be equity shareholders. That is the order of financing is this according to pecking order theory. Okay. Next is your trade-off theory. Yes, again, similar based on your model with tax. It is very similar to model with tax. Okay. So what do we say here? This is the optimum debt level. Okay. Now optimum debt. This is your debt level. Okay. This is your optimum. So what is happening here? Yes. Value of the unlevered firm. This is value of the unlevered firm. Correct. So obviously value of unlevered firm doesn't matter what the debt value is, correct or not?
Yes.
It doesn't matter what the debt value is, value of unlevered firm will be same, like this. then your value of levered firm will increase with the increase in debt, yes or no? Yes, will
Yes,
increase. Initially it will increase, correct or not? Initially it
Yes,
will
sir.
increase, but later on it will start coming down with the too much increase in the debt. Are you understanding?
Yes,
Yes.
sir.
So
Yes,
this
sir.
is the
Yes,
formula, that is value of levered, unlevered firm plus A. What is A? A is the tax advantage on debt. What is this formula? Based on MM model with tax, yes or no? Value of unlevered firm plus tax advantage on debt is nothing but your MM model with tax, correct or not? Okay, so that is the thing. However, trade-off theory says you should also consider cost of financial distress and agency cost. What is this cost of financial distress and agency cost? It says that in the case of winding up tomorrow, if it goes to an insolvency case, yes, so there is when there is a debt, obviously the cost will be higher because you need to first pay the debt holders and then the equity holders. Yes or no? First you pay the debt holders, then you pay the equity holders. You need to pay for a lot of charges for the liquidator and all of that. So all that cost of financial distress, present value of that should be minused, should be deducted from the value of the firm. So that's why the formula is value of levered firm is value of the levered firm is value of unlevered firm plus tax advantage on debt minus cost of financial distress. Did you all understand?
Yes,
Yes.
sir.
Designing optimum capital structure, ROI, ROE relationship. I always, discuss this in detail in the class. Return on equity is nothing but return on investment plus ROI minus interest. Why ROI minus interest? Because fixed, see, capital employed first is say 100 lakh. Capital employed today is 100 lakh. Then I'm making it 200 lakh. My return on the 200 lakh will be the same. Yes, sir. I will increase my return. But however, I have to pay my debt holders at the fixed interest rate. So the differential is my gain, yes or no? Because the debt already is covered. Yes, are you guys understanding this? Debt is already covered. So therefore, what I earn in excess of the interest is my earnings as an equity shareholder. But obviously, it has to be in the debt equity ratio, debt equity into 1 minus T. Okay, now that is the formula. So that is why the theory says when ROI is greater than interest, debt is preferred. Yes or no? Correct? Because entire savings between, say the return on investment is 20%, interest rate is 10%, right? So after paying you guys, say you are my debt holders, after paying 10% to you, say my return on investment is 20%, entire 10% I retain as an equity shareholder, correct or not? So that is why when ROI is greater than I, debt is preferred. Yes, go for more and more debt because I can make more money on the savings. When ROI is less than I, then obviously equity is preferred. Yes, when ROI is equals to I, then indifference. EBIT EPS relationship, that is your price earning ratio, your P naught. Your price is nothing but MPS. Your MPS nothing but price by equity into EPS. Clear? Financial break-even point. It is what? Financial is that level of EBIT at which EPS is equals to 0. Yes, it is that level of EBIT at which EPS is equals to 0. Interest plus preference dividend by 1 minus T. Clear, all of you?
Yes, sir.
How did I get this? Interest. EPS should be 0, Andre. I should be able to at least pay my interest and preference dividend, correct or not? Yes. So interest divided by 1 minus T plus preference dividend. Okay. Interest divided by 1 minus T plus preference dividend is nothing but my, okay. Interest plus PD by 1 minus T is nothing but my EPS. Okay. Next, indifference point. So that is the point at which the EPS. So EBIT, right? EBIT is the same in both the scenarios, but EPS is changing because of maybe change in interest. Indifference point at what? So if there are two different scenarios given, yes, if there are two different scenarios given with different number of shares, with different number of shares for equity shareholders, Next, one has interest, the other has preference dividend. Which one? At what point will EBIT be same under both scenarios? That when EPS will be same under both scenarios. Under what point? At what EPS will be same under both scenarios? That is nothing but my indifference point. Clear, all of you?
Yes, sir.
Yes, sir.
Okay. Let's take a break and come back. Yes.
Yes, sir.
There.
Okay, is 1.9 now, 1.20, all of you be back. Okay, 1.20.
Okay,
Thank
sir.
you, sir.
Bye, all of you.
Bye, sir.
Thank you, sir.
Come back, all of you.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, come back for others. Bega, Darshan, Deepika, Varshini, Sahana. Kartikeya, Srinandan Joshi, Chaitanya, Vijay Kumar. In attendance, full ಎಲ್ಲಾರ್ದು ಹೆಸರು ಕರೆದ ಮೇಲೆ ಆನ್ ಮಾಡ್ತೀರಾ? You will do it on your own. Yes. All right. So, like I said, I'll quickly just go through that IRR. Okay, all of you concentrate now. Simple concept. Yes, which is confused. The students get confused. Very easy to calculate IRR. Okay, now. But students get confused. I think I want to do it after the break. Now, see now. Yes, 5% preference shares. Yeah, problem is that note down ಮಾಡ್ಕೊಳ್ಳಿ first ಬೇಕಿದ್ರೆ. 45. No, page 140. I told no, I'll do after the break. That one.
Yes,
Okay.
sir.
5% preference shares of rupees 100 each at a premium of 10%. Andre, at what price are they issuing the shares? 100 plus 10, 110. Yes or no? These shares are redeemable after 10 years at par. So redeemable at 100 rupees. Flotation cost is 6% of the issue amount. What is the issue amount?
110.
110. So 6% of that. Yes, 110 minus 6.6. 110 minus 6.6 and corporate tax rate. Okay, that is not relevant. Okay, come on. Yes, so check here. 110 minus 6.6, 103.4. Correct or not? And redemption value is 100. Yes, redemption value is 100. So that is what they're doing here. So your initial cash flow is 103.4. Correct or not? 103.4. Later on, yes, later on you're getting 5%. 5% every year on 100. Yes, 5% every year on 100. Correct or not? So that 5% on 100 you're getting for 10 years. 10 years, and then redemption value is 100. Did you all understand this?
Yes.
Yes. So initially 103.4 is the issue price. This is what you received. You paid out 42.65 and 74.4 based on the present value factor at 3% and 5%. Yes. Now, how do you calculate this 3% and 5%? Obviously, it is based on an approximation, but obviously it will be somewhere close to your interest rate of 5%. Artha aita? Somewhere close to the interest rate of 5%. So other madhyadalle they are found out. Did you understand? That is how they're taken 5% and 3%. So 8.5.3 and this. I hope for this you don't need my explanation. Even in capital budgeting, sir would have covered it. Okay, 13.65 and 3.39. Did you understand? This is the NPV at 3% and NPV at 5%. Did you all understand this? However, IRR means what? IRR means NPV should be how much? ಆಗಿದೆ ಕಾನ್ಸೆಪ್ಟ್ 0. Correct or not? NPV should be 0. So I draw a simple price line now. Check. Not right, sorry. Idu rate line, percentage line. Okay. So at 3%, what is the NPV? Minus 13.65. Correct or not?
Yes.
At 5%, what is the NPV? 3.39.
3.39.
However, I want it to become 0. Correct? I want it to become 0. Did you understand this? So it means when I change the rate by 2%, when I change the rate by 2%, NPV is changing by how much? 13.65 plus 3.39. Yes or no?
Yes, sir.
Yes, sir.
Is how much? Okay, they have already done 17.04. Yes, 17.04. So that is what we write it like this. When yes, so when there is a 2% change in the rate, NPV is falling by 17.04. Correct or not? When there's a 2% change in the rate, NPV is falling by 17.04. Therefore, at what percentage rate? Yes, at what percentage rate will the NPV become? Yes, tell me.
13.5.
Will the NPV become how much in this case? Correct?
0.
2%.
13.65.
0 alla. 13.65. Did you understand?
Yes, sir.
Yes.
Yes. See, 13.65 ಆದ್ರೆ 0 ಆಗುತ್ತಲ್ಲ. ಇಲ್ಲಿ 13.65 is there. Correct, Chinmay? At 3%, it is 13.65. So how much percentage should it change so that it becomes 0 andre 13.65 change ಮಾಡಕ್ಕೆ what is the percentage, that is a question mark, but the NPV value is 13.65. I think that is very clear. When I'm coming from 3% to 0, NPV should reduce by 13.65. Yes or no? Yes, NPV should reduce by 13.65. No, percentage I don't know. Percentage is a question mark, but NPV should raise by 13.65. So I repeat, with a 2% reduction in the rate, with a 2% reduction in the rate, NPV is changing from 13.65 to 3.39 with a different negative, one is positive. So you add both. Artha aita? One is negative, one is positive. So you add both. So the change in NPV is 17.04. Change in NPV is 17.04 for a 2% change in the rate. What should be the percentage change in the rate such that the NPV changes only by 13.65, not by 17.04, alva? It should change only by 13.65. So cross multiply 13.65 into 2% divided by 17.04. That is what they have done here. Yes, 3% plus 2% divided by, ಗೊತ್ತಾಗ್ತಾ ಇದೆಯಾ? 2% into 13.65 is here in the numerator. Can you see? Divided by 17.04. That is nothing but my IRR method. Is this understood by everyone?
Yes, sir.
Okay.
Yes, sir.
My class notes is there. In the class notes I have given. You guys also have done the same way. Okay na? Adna matte innonsati revise ಮಾಡ್ಕೊಳ್ಳಿ. All of you understood? Go by this approach. Very easy. Don't go with the perimeter approach. You'll get confused. Yes or no? Low, high, ಏನೇನೋ ಇದೆ ಅಲ್ಲಿ. I hope this is easy for everybody. Correct or not? This is easy.
Yes, sir.
Yes. So ivaga, if you're now, you don't have to draw the even this percentage line every time. Okay. You don't have to draw this percentage line. Just do this very simple. Again ಮಾಡ್ಬೇಕು. Yes. So very simple agi, you just have to write down this. Okay. What is the percentage change from 3% to 5%? 2%, correct? Iste barkodi. Pakkadalli, what is the change in the NPV? 13 minus and plus, that is very important. If both are plus, take only the difference. If both are negative, take only the difference. If one is plus, one is negative, you add both. Gotaita?
Yes,
You write
sir.
down 17.04. Okay. Now, I wanted to change only by 13.65, correct? If I'm coming from 3%, if I'm coming from 5%, then it will be 3.39 and should make it negative. Adella madak hogbedi. Always go forward. Be positive in life. Be always positive in life. Okay na? So adike 3% in the S jasti agbeku. That is what you see. Okay. So the percentage change I need is 13.65, but I don't know what is the the amount NPV change is 13.6. I don't know what is the percentage change. Just cross multiply 2% into 13.65 divided by 17.04. Obviously, you are moving forward from 3%. Alva? You are moving forward from 3%. So you add 3% plus this, you'll get the answer. That is what is here. Clear? Yes. One direct sati madi. Which you should have already done many times during the class, but anyway, adru one direct sati madi, you'll get a hang of it, and then you can easily do it. Clear, all of you? Yes.
Yes, sir.
Okay. Now come to the problems of capital structure. Come to the problems of capital structure. Hedi.
150.
150 na? Yes. Capital structure. Idina, this is November. Okay. This is November. Typing error aste. But the Prakash Limited is the November RTP problem. Yes. Prakash Limited provides you the following information. Profit EBIT is 3 lakh. Okay. Less interest on debentures is 50,000. That means what is the debenture value? Debenture value is how much? 5 lakh. Correct or not? 50,000 by 10% is 5 lakh. EBT is 2.5 lakh. Interest at income tax at 50% is 1,25,000. Therefore, your earnings after tax is 1,25,000. That is nothing but the earnings available to equity shareholders. Number of equity shares is given is 25,000. Therefore, earnings per share, divide this, you get 5. Price earning ratio is given. Artha aita? Therefore, what is your market price? Market price per share. Earnings into P. Yes or no? Earnings into P. Can I say it is 50? Correct? Yes. Next, what is the value of equity shares? Equity shares value 25,000 into number of equity shares is 25,000 into 10. Yes or no? 2.5 lakh. ಗೊತ್ತಾಗ್ತಾ ಇದೆಯಾ? Yes. The company has reserves and surplus of 7.5 lakh. That means equity, total equity is how much? Total equity is equals to 2.5 lakh plus 7.5 lakh, 10 lakh. All of you are agreeing? And then debt value is 5 lakh. Nodana. If there's anything else, we'll see. Required further capital for modernization. That means existing is only 15 lakh. Existing is only 15 lakh. Did you all understand? Question, I'm explaining the question. Okay. To this, I will add a further capital of 5 lakh. Now, whether it's debt or equity, we don't know. It will become 20 lakh. Clear? After addition, it will become 20 lakh. Okay. Now, let us understand. Return on capital employed is constant. That means first I need to find out what is the return on capital employed on this. What is the return on capital employed formula? What is the return on capital employed formula? Hedy? Anybody?
EBIT by capital employed.
Very good. Yes, EBIT divided by your capital employed. Your current EBIT is 3 lakh. Your capital employed is how much? Present capital employed. Yes. Just now I did 15 lakh. Alva.
Sir.
Yes or no? Now we'll
Yes,
see
sir.
later. Later on, we'll see how the question develops. Okay. Debt equity ratio higher than 40% will bring the PE ratio down to 8 and increase the interest rate debts to 12%. That means it is understood, since the PE ratio given is 10 here, it is understood that the debt equity ratio currently is 40%. Less than 40%. Currently is less than 40 because 10 they have given. However, if the debt equity ratio increases beyond 40%, then the PE will come down to 8. Is this understood by everybody? Ascertain the probable price of the share if the additional capital is raised as debt. Okay. If it is raised as debt, that means here this entire 5 lakh, if it is debt, then what will be the debt equity ratio? What will be the debt equity ratio? 50-50, because 20 lakh is total, correct or not? What is the total debt now? 5 lakh is additional, 5 lakh is present, 10 lakh will become debt, yes or no?
Yes,
Artha agta idya?
Yes, sir.
Yes, sir.
Is debt. Your existing equity is 10 lakh. ಗೊತ್ತಾಗ್ತಿದೆ ನಿಮ್ಗೆಲ್ಲ? Yes. So is it increasing beyond 40%?
Yes, sir.
Yes, debt by total debt. So therefore, then it will reduce, definitely reduce to 8. Okay, we'll see the question down. And increase the interest rate on additional debts to 12%. Okay, you're required to ascertain the probable price of the share if the amount is raised by issuing equity shares at ruling market price. So these are the two scenarios. One is based on debt, one is based on issuing equity shares of 5 lakh and 5 lakh. Clear? Yes. Now let us see the working notes first. Clear? Return on capital employed 3 lakh by 15 lakh. I did this, yes or no? 20%. Yes. Number of equity shares to be issued in plan 2. Yes. If we are going with this equity share issue at 5 lakh, what is the current market price we need to find out? Okay, now. Yes. Current market price we have already done. Yes, above. Check. EPS into MPS I did, yes or no?
Yes,
Yes,
sir.
sir.
EPS into
Yes,
MPS. EPS into price equity ratio, PE ratio. Yes, 5 into 10, 50. I already did on top. That is what they have taken here. 5 lakh divided by 50, 10,000 shares. Okay, that means the number of shares existing is how much? 25,000 given here. Here, 25,000, correct? 25,000. So to that, I will add the 10,000. It will become 35,000 shares. Okay, then debt equity ratio, if 5 lakh is raised as debt, so I told you it is 50%, correct or not? Yes. So 20 lakh again, it becomes 10 lakh. That is nothing but your existing 2.5 lakh equity plus 7.5 lakh of retained earnings and 10 lakh of debt. That is what? Again, old and new. Old is 5 lakh. New is 5 lakh. Artha aita idu? Yes.
Yes, sir.
Now come back. The main answer is here. That's it. So earnings before interest and tax. Yes. So return on capital employed is constant 20%. We found out the new capital employed is 20 lakhs. Yes or no? Correct. So 20% of 15 of 20 lakhs, that is 4 lakh and 4 lakh in both scenarios, it will be same. Interest on old debentures, 10% of 5 lakh, 50,000 is not changing. Interest on new debentures, only in plan 1 it will come. Yes, plan 1. That is 12% of why 12%? Because PE ratio is changing, yes or no? More than 40%. Therefore, interest rate will become 12% given in the question. Okay. So 60,000. Then Your earnings before tax, you find out, and then tax rate, and then earnings after tax. Number of equity shares, I told you, when debt is raised, it will be same as old, 25,000. When debt is not raised, it will become 35,000. Yes or no? Earnings per share, you find out by dividing by number of shares, multiply the PE ratio, you get the market price. Clear? So in such a case,
Yes.
which is the one? We'll go with which option? Which is giving higher market price? That is by issuing equity shares. I hope this is clear.
Yes, sir.
Yes, sir.
Next, the following information pertains to CISA Limited. Equity share capital, retained earnings, preference share capital, 12% long-term loan, interest coverage ratio formula. Interest coverage ratio formula, anybody? Yes. How much of the EBIT is able to cover my interest? Yes or no? How much of the EBIT is able to check here? How much of the EBIT is able to cover my interest? Correct? So EBIT divided by interest is nothing but my interest coverage ratio. That should be a hint. By now, you should know ratio as muksil by now. Sir, Saturday madudru tane. Yes.
Yes, sir.
So 8 andre immediately interest coverage nodid takshana you should get the formula in head. Okay, why are they given this? What can I find out? Now tell me, what can I find out using interest coverage ratio? EBIT. Yes, I can find out my EBIT because this is given, and then 12% long-term loan debt is given. Correct? So what is the 12% on 10 lakh? 1.2 lakh. Correct? Interest service coverage ratio. So interest is some. What is the formula? Interest service coverage ratio is equals to EBIT divided by interest. EBIT I don't know, but 8 is equals to EBIT divided by 1.2 lakh, cross multiply. Therefore 9.6 lakh. Yes or no?
Yes, sir.
9.6 lakh is my EBIT. Next, let us continue. The company is proposed. So this is all given. Okay, interest tax rate, and then PE ratio is given. The company is proposed to take up an expansion plan which requires an additional investment of 34.5 lakhs. Okay, due to the proposed expansion, earnings before interest and tax of the company will increase by 6 lakh 15. That is what is the new EBIT after the expansion plan. 9.6 lakh plus 6.15. Yes or no? Correct? So 15 lakh something, 15.75. Yes or no? Okay. Are you understanding?
Yes,
Yes,
sir.
sir.
Yes, sir.
Is the addition to the current EBIT of 9.6 lakh, you get 15.75 lakh. The additional fund can be raised in the following manner: by issue of equity shares at present market price, or by borrowing 16% long-term loans from bank. You are informed that the debt equity ratio, debt by shareholders fund, in the range of 50% to 80% will bring down the price earnings ratio to 22, whereas debt equity ratio over 80% will bring down the price earning ratios to 18. Clear? So debt equity ratio I need to find out again. Okay, now advise which option is most suitable. Now see, so 9.6 lakh is the EBIT. We all found the same thing. Yes or no? Then proposed earnings before interest and tax after adding the new capital will become 15.75 lakhs. Correct? First one, equity option. If you're going with entire equity, what is the addition? 34 lakh 50,000, and entire equity shares of rupees 10 each. Equity shares of rupees 10 is, that means existing number of shares is how much? 80,000 shares. Correct? 80,000 shares. If I go entirely with equity, 34 lakh 50,000, that means how many will be the number of shares? Yes, what will be the number of, what is the, for that I need to find out what is the market price. What is the market price? Price earning ratio is 25. EBIT is given. I need to calculate what is the earnings per share first. Okay, now check here. $9.6 lakh is given, correct? 9,60,000 we found out. Interest is 10% of 12 lakh given in the question. All of you concentrate. 1.2 lakh. Therefore, earnings before tax 8 lakh 40. Yes or no?
Yes, sir.
Correct?
Yes, sir.
Taxes, tax rate is given here. Check here. Tax rate is given 30%. Yes. So 30% of this 2.52 lakh, you get earnings after tax of 5.88 lakh. Then there is another preference dividend, market important. You'll miss this. Okay, you miss the preference dividend adjustment before finding out the equity dividend. 9% of preferential capital of 100 each. 12 lakh, 9% of 12 lakh, 1,08,000. Therefore, earnings available to equity shareholders 4,80,000. Number of shares I found out. How did I find out? 8 lakh divided by 10. Yes or no? Sorry. Yes, 8 lakh divided by 10. Correct. 80,000 shares. Here 80,000. Therefore, EPS is 6. Price earning ratio given in the question is 25. Therefore, market price is 150. Did you all understand this? So now you should do it. Actually, this you will get confused if you go, sir. How did they get this? First, you need to do this. Only then you will get this. Did you understand? You need to do this. Only then you'll get this. Correct. So now you'll understand that the new equity shares to be issued will be number of shares 34,50,000 divided by market price of rupees 150. Correct? 34,50,000 divided by market price of 150. Number of shares is 23,000. Did you all understand? Additional shares, existing shares is how much? It is given here. Check. We found out already 80,000. So the new shares will be 80,000 plus 23,000, which is equals to 1,03,000. Clear? This is my new shares. Next. So now calculation of EPS and MPS under the two financial options. So EBIT 15,75,000 we found out. Interest rate is same 1,20,000 on the old debt. On new debt it is 16% of 34,50,000, 5,52,000. Earnings before tax they have found out 14.55 and 9,03,000. Tax rate is 30%. You minus the tax or profit after tax. Then preference dividend I told you is 1,08,000 minus that, and then number of equity shares. Can you check this 1,03,000? Again, see there is no working note here. Directly 1,03,000 has come. It's nothing but if you want 80,000 plus 23,000. That's 1,03,000. Here, since only debt is there, number of shares is not changing. 80,000 only. EPS is 8.84 and 6.55. Your price earning ratio you need to find out. Have they found out? No. Yes, price earning ratio we need to find out. Yes. Existing debt is how much? Existing debt. Check here. 12 lakh. All of you are there and understanding. Existing debt is 12 lakh. Correct? Your equity share capital is 8 lakh. Retained earnings is 20 lakh. Preference dividend is 12 lakh. Okay, now sorry. Existing capital is debt is 10 lakh, guys. 10 lakh. Sorry. Okay, now. So now check here. Some they should have done something. Here they've done. Okay, here they've done. Check here. So debt is 10 lakh. Shareholders fund 8 lakh plus 12 lakh, 20 lakh plus 12 lakh plus 34.5. This is addition. Correct? This is my addition to the existing shareholders fund 74.5 lakh. So 10 lakh divided by 74.5, that is debt by shareholders fund is 13.42%. This is what normally debt equity ratio means. What? Debt by equity na Allah, debt by total. Correct or not? Debt by total is by debt equity. But however, in this problem they have only specifically mentioned. Can you check here? Debt equity ratio, that is debt by shareholders fund anta. Okay, that is why formula. Debt by shareholders fund 13.42%. Since it is, therefore it will be P will be 25 times. In option 2, if you check, entire 30.4.5 is added to debt of 10 lakh, 44.5. Existing shareholders fund is 40 lakh, 44.5 by 40, 11.25%. It is more. Therefore, it is 18 times given in the question. Artha aita? P 18 times. The same thing is taken here, 25 and 18. I hope I'm clear. Yes. So in this case, obviously, market price for equity share option is higher. You go with this option. Okay. Next. For this, I think question was circulated. Question print agilila. I told them to share it in the group. Has it been shared? I think many of them are not on WhatsApp.
Yes, sir.
So yeah, just take that. Okay, or RTP May 23. That's all. Question you'll get it online. Okay, now
Yes, sir.
RTP May 23 question you'll get it online. But anyway, I told her to share. This is the RTP May 23. Can you see the? I don't think if you can see. 1 second. Yes. Now can you see the screen?
Yes, sir.
Yes,
Yes, sir.
So this is the problem. Capital structure of XYZ Limited is as follows. Equity share capital is 7 lakhs. Face value is rupees 20 each. Reserves is 10 lakhs. 9% bonds of 3 crores, 11% preferential capital, 3 lakh shares of face value of 50 each. Additional funds required for XYZ Limited is 5 crores. Okay, na? XYZ Limited is evaluating following alternatives: raise the funds via 25% equity capital and 75% debt at 10%. P ratio will be 12. However, if it raises 50% via equity capital and rest from 12% preference share capital, P ratio will be 11. Okay, P ratio will be 11. Any new equity capital would be issued at a face value of rupees 20 each. Okay, any new preference share capital would be issued at a face value of rupees 20 each. Tax rate is 34%. Determine indifference point under both alternatives. Indifference point formula is what? EBIT. It is that EBIT under both scenarios where EPS is the same. EBIT under both scenarios where EPS is the same. Yes or no? Yes. Now look at the answer. Check here. So the current capital structure is given here. 20 face value. Yes, check here. Yes, where is it given? Face value 20. Can you see? And 7 lakh shares. That is multiplied. 20 into 7 lakh. 1.4. 140 lakhs. Next, reserves is given here. Okay. 10 lakhs. You are able to see both the screens. Yes.
Yes, sir.
Yes. So 10 lakhs. 10 lakhs. That reserves is taken here as 10 lakhs. Okay. Next, 9% bonds of 3 crores. 3 crores. Next, 11% preferential capital. 3 lakh shares of 50 each. That is taken here. 350 into 3 lakh. 150 lakhs. Total is 600 lakhs. Okay. This is my existing capital structure. Proposed. So what is this? This 500 will be same. Proposed is addition. Another 500 lakhs is being added. Yes or no? Here, check here. Another 500 lakhs is being added. Correct? So that 500 lakh in the ratio of first 75 and then 25. The balance is 50 and 50. Okay, now check here. First 25 and 75 between equity and debt. Okay. Next one is 50 and 50 between equity and preference shares. Clear, all of you? This thing you add it to the existing one. This one, both you add it. That will come here. Combined capital, right? Existing, you check 140 plus 125, 265. Next, 140 plus 250 is 390. Same way, you do it for all. You'll get the combined capital of 110. Okay, 11 crores. Interest for proposal 1, you have to find out. Okay, proposal 1 is this. Interest on this, that is 9% of this and 10% of this, correct or not? 9% and 10% at their value. So you find out 300 lakhs into 9% plus 375 into 10%, you get 64.5. Okay. Next, preference dividend for proposal 1. Yes, what is the preference dividend? 150 lakh into 11%. 11% of this, yes or no? Correct, 11%. That is 16.5 lakh. Clear, all of you? Are you guys understanding?
Yes, sir.
Next,
Yes, sir.
interest for proposal 2. Yes, 10% debt is 0. On that it will not come, but 9% on bonds. So if you check here, only 9% on the bonds is come, 27 lakhs. Yes. Next, preference dividend for proposal 2. You will have both preference dividend of 150 lakhs and 250 lakhs. One is at 11%, the other is at 12%. So 11% into 150 lakhs, 12% or 250 lakhs, total 46.5 lakhs. Okay. Total is 46.5 lakh. Are you guys understanding?
Yes, sir.
Yes.
Yes, sir.
Obviously, let the indifference. What is the indifference? It is that level of EBIT, correct? It is EBIT. So they're assuming the EBIT to be X. Clear? They're assuming the EBIT to be X. So it is that level of EBIT where EPS under alternative 1 will be equal to EPS under alternative 2. Correct? That is my indifference point. Yes. So that is why EBIT is X minus interest. Correct? EBIT minus interest into 1 minus tax rate. Tax rate is 34% given in the question. Okay. Therefore, it is 66% here. So EBIT minus interest into 1 minus tax rate minus preference dividend for alternative 1. If you can check here, it is 16.5 lakh. The same thing is given here, 16.5 lakh. Okay. Divided by 13,25,000. Yes. Divided by 13,25,000. What is 13,25,000? Yes. Number of shares. Check here. That is the number of shares. So equity here is 265 lakhs, correct? What is the face value? 20 rupees.
Yes,
20
sir.
rupees. So 265 divided by 20 is nothing but given here 13,25,000. And here, if you see, you divide this by 20, 390 lakh divided by 20, it is 19.5 lakh. Did you understand? Yes. Then interest, Subiksha, interest is taken 27 lakh for proposal 2 here. Okay. 27 lakh. And then preference dividend for the second proposal is 46.5 lakh. Minus it. You all know, I hope you are understanding this equation, correct or not? EBIT minus interest into 1 minus tax rate minus preference dividend is what is the earnings available to equity shareholders. From that, I divide the number of shares, I get EPS. I'm equating both the equations. That's all. So equating one with two, you get, and solve for the equation, you'll get what is the EBIT. Okay, now that is your indifference point problem. Next. Question paper of November 22. The following are the costs and values for the firms, firm A and B, according to traditional approach. Okay. So traditional approach, Ali, total value of firm is 50,000 and then 60,000 they've given. Market value of debt is 0 and 30,000. Market value of equity 50,000 and 30,000. So this is what, nothing but V plus your debt plus S is equals to V, alva. Debt plus equity is V. So this is what? This is your debt. This is your equity. This is V. Add both. Okay, next. Expected net operating income. This is what? This is the income. That is nothing but EBIT. Yes or no? Interest before earnings before interest and tax. Cost of debt 0 because it is an unlevered firm. This is levered firm. Okay. Cost of debt is 1,800 here. Net income 5,000. Right? Net income is 5,000. This is what? Earnings before tax. Here it is 3,200. Then cost of equity, net income by value of the firm. Yes, net income by value of the firm is 10% and 10%. Clear, all of you? 10.7%. Compute the equilibrium value of firm A and B in accordance with the approach. Assume that taxes do not exist and equilibrium value of KE is 9.09%. That means what? See, if you can check here, are the value of both firms same? Same. One is 50,000, other is 60,000. Yes or no? All of you sleeping? Yes, sir.
No, sir.
No, sir.
No, sir.
Yes. Okay. Value of the firm is 50,000 in firm A. Firm B is 60,000. But check the net income. EBIT. If firms with same EBIT and the same risk class should have actually the same value. Yes or no?
Yes, sir.
Some with EBIT of the same value, the same risk class should have the same value. Correct. But however, in this case, it is more. So this is value of unlevered firm, value of levered firm. Which value is higher? Firm A or firm B?
B.
Firm B.
Firm
From
B.
B.
Firm B,
B,
correct
yes,
or not? So you will move from firm B to firm A because you're getting this at a lower price, even though both are of same price. Yes or no? Artha agta
Yes,
idea?
sir.
Yes.
Yes. Your gold, remember my gold example, gold in two markets. You will go to the market where gold is lesser and buy. Yes or no? So VU, if this is lesser, you go and buy firm A. Clear, all of you? So you cannot consider this to be the KO and equate it. Normally, what do I say? VU is equal KE of VU. KE of the VU, that is KEU, is equals to KO of the levered firm. Normally, this is when equilibrium is reached. Artha agta idya? This is when equilibrium is reached. Here, is equilibrium reached? Not yet.
Sir.
Therefore, I cannot take this rate. What I need to consider is this rate. Did you understand? 9.09% because here equilibrium value anta kottidare. Did you understand fundamentally? Conceptually, did you understand why you should take this 9.09%? Because only after equilibrium is reached can you say the value of both firms is same. Until then, you cannot equate KE of the unlevered firm and say it is nothing but the KO of the levered firm. Okay. Only when it is equilibrium is reached, you can take. So this is what 9.09 you will take for computation. Compute value of equity, cost of equity for both the firms. Okay, check now. Here, computation of equilibrium value of firms A and B under approach. So if you check here, they have taken KEU into 1 minus T. Yes, T is 0. Just very simple. You don't have to do all that. KO is equals to KEU, which is equals to 9.09%. There is no tax rate, right? There is no tax rate there is no tax in an unlevered firm. So there's no point of T there. Okay, next. EBIT is same for both. So you divide it by KO, value of firm will be same. Did you all understand this? Yes.
Yes, sir.
Yes. Next, check this. Calculate the value of equity and cost of equity for both firms. So value of equity in firm A, which is unlevered, will be equal to the value of the entity, yes or no? Correct? Because value of debt is 0, total value V is nothing but value of equity.
Yes, sir.
Yes, value of equity. So now coming to this, V minus value of debt. V minus value of debt is nothing but value of equity.
Yes.
Yes, sir.
Clear? Nothing but value of equity. That's all they've done here. Okay. Next, how do I find out the cost? Very simple. Cost. How to find out the cost of equity here? I'll tell you. Cost of equity is nothing but, what is the formula for KE? KE under this traditional approach and all, what is the formula? Net income divided by value of equity. Yes or no? That is nothing but S. Value of equity is yes. So net income by S. Aste. Net income is how much here? Yes. Net income is how much? Check. Sorry, net income is 3,200. Value of equity is how much? 25,005. So 3,200 divided by 20,005 is nothing but 12.5. Also, you can use the formula. This formula also you can use. That is KO plus KO minus KD into debt by equity. Correct or not? Into debt by equity also, if you do, you will get the same answer. Clear, all of you?
Yes, sir.
Yes. The firm has more capital than its requirements. Andre, what? Remember, there's a small theory concept that covered in the class. Over-capitalization given here. Yes. Over-capitalization. Yes. It is over-capitalization. So what is the situation called? It is called over-capitalization. Give the two consequences of it. Okay. Consequences are considerable reduction in the rate of dividend. Dividend will come down, and interest payments. Okay. Reduction in market price of shares. Obviously, over-capitalization, is it good? Is it good? It's not good. So obviously it impact my market price. Resorting to window dressing. What do I mean by window dressing? Basically, falsifying the figures, manipulating the figures. Okay, that is window dressing. Some companies may opt for reorganization. Yes, to rectify it a step. However, sometimes matter gets worse and company may go into liquidation. Okay, because of overcapitalization. What are the important factors considering considered for deciding the source and quantum? The CRC class madidini. Yes, CRC is there. Okay. Control, risk, and cost. Control is from the perspective of the equity shareholders. Existing equity shares, very important. It is my existing equity shares. Yes, control is from the perspective of the existing equity shareholder. Otherwise, you tell me, when I told you that when ROI is more than I, what did I tell you? What is preferred?
Debt.
When return on debt is preferred, yes or no? Correct. Debt is preferred. Correct. So control is with the existing shareholders. Did you understand? I am retaining the control of the existing shareholders and going with debt. Correct or not? That is why control is from the perspective of the existing shareholders always. Otherwise, you can say, let me go with new equity shares. Right? What is the problem? So control with the existing shareholders should not reduce. That is what is control. Next, obviously, risk should be least. Your risk should be least. Correct? Risk should be less, and overall cost of the capital remains minimum. Problem is when you address control, correct? When you address control and you increase debt, what will happen to KE? It will normally increase. Traditional approach is the most realistic approach. I told you, yes. When debt increases, KE also will increase. So therefore, don't you think KO will increase? Yes, KO will increase. So what is happening? When one you're controlling, other is going out of hand. If you control the cost, maybe the ownership will go out of hand. Correct or not? Yes. So that is why you need to find a balance between all of this, and that's the whole chapter of capital structure. But now to answer to the point, your factors is nothing but CRC, control, risk, and cost. Control, risk, and cost. Yes. ABC Limited provides you the following information. Okay. earnings before interest and tax, interest, earnings before tax, number of equity shares, everything is given. Undistributed reserves is 7 lakhs, further 4 lakh for expansion, investment return is same. So this is also same way. Okay, P ratio is changing. Are you guys able to do it? Yes, same thing it is. Whatever we have discussed
Yes,
so far,
sir.
similar problem, you guys can go through this. Same thing. Okay. Yes. Raj Limited for the see the particulars related to Raj Limited is given. Capital structure of the company as on 31st March 22 is as follows: equity shares, reserves, and current liabilities. Raj Limited has decided to undertake an expansion project. Again, similar concept. Okay, what they've given is expansion project. Okay, what is the expansion? Check here. It involved 20 lakhs. They've given debt here. So what is happening? Your debt equity ratio is changing a step. Yes or no? Your debt equity ratio is changing. So if it is 20, that means this will be 15. If 20, this will be 10. Correct? Equity will be 10. This will be 6. Clear? Debt equity ratio. For 3 different scenarios, you need to find out which is better. Okay, which is better. See, the additional output can be sold at the existing selling price without any adverse impact on the market. They're saying the quantity is also increasing. Fixed cost will be increased by 5 lakh. Variable cost per unit will be decreased by 15%. Artha agta idya? Yes. The company expressed an output increase by 50%. So, therefore, you're supposed to find out what will be the revised EPS. Clear? Then they have given you different interest rate for different levels of debt. Find out about under which alternative EPS is maximum using and assuming corporate tax rate is 40%. Okay, now check here. Output is increasing by 50%. Yes or no? Correct. Output is increasing. What is the output? 1 lakh. Can you see? It is increasing by what percentage? Yes, Acharya Naman. In class note. Yes, it is increasing by what percentage? 50%. Yes, full energy ಹೋಗ್ಬಿಟ್ಟಿದೆ ಇದು ನಿಜವಾಗ್ಲೂ ಹೇಳ್ತಾ ಇದೀನಿ
No, sir.
their energy is gone. Yes.
No, sir.
It is increasing by how much percent? It is given here. No, we just now read. It is increasing by 50%. Output by 50%. Then why are you all sleeping? Yes, quick. That alertness is gone. Yes, 1 lakh plus 50%. 1,50,000.
Yes, sir.
Yes.
Selling price per unit, they're saying that they can maintain as it is. Variable cost is reducing by 15%, so it is becoming from 20 to 17. Okay, therefore revised contribution per unit is 23. Marginal costing ನೆನಪಿದ್ಯಾ ಅಥವಾ ಅದು ಮರ್ತೋಗ್ಬಿಡ್ತಾ ಇವಾಗ? Yes,
Yes, sir.
so yes, ಗೊತ್ತಾಯ್ತು. Total contribution is what? Yes, multiply into the number of units produced. Okay, now concentrate. After this, leverage a small chapter is there, and then we are done. ಆಮೇಲೆ ನೀವು ಮಜಾ ಮಾಡಿ ಏನ್ ಬೇಕಾದ್ರೂ ಮಾಡಿ. Okay, 1,50,000 into contribution. That is my revised contribution is 34.5. Fixed cost is increasing by again 50%. Okay, now so 10 lakh is becoming 15 lakh. So EBIT is 19.5 lakh. Clear all of you?
Yes, sir.
Yes, sir.
Then the interest cost is found out at different rates. Okay, for 5 lakh at 10%, 15%, 10, 15, and 25. Total is done here. Number of equity shares. So idenidu, on what basis did they get this 5 lakh, 10 lakh, and 14 lakh? Yellow figure nodang agta idya? Slab wise. You check here. This is what I did here. 15 lakh, 10 lakh, and here balance. Yes or no? So that is 5 lakh, 10 lakh, and 14 lakh. The same things have come here as stay, but based on slab wise they've done. Did you understand? For each
Yes,
slab they've calculated the interest in my separately. All of you understood? 50,000, 1,25,000, and 2,05,000. Then number of equity shares to be issued. Now this is the balancing figure. If you check here, I've done it. Yes, you'll notice 15, 10, and 6. Correct? 15, 10, and 6.
Sir.
That's what they would have done here. Yes. So 15, 10, and 6. Divided by the market price, you get the number of shares. Divided by the market shares, you get the number of shares. Calculation of total equity shares after expansion. Add existing number of shares. Okay, plus the additions 7,500, 5,000, and 3,000. Adane 7,500, 5,000, 3,000 added, and you found out what is the total number of equity shares. Clear all of you?
Yes, sir.
Yes. So if these working notes are done, then your answer is simple. Your EBIT, that is 19.5 lakh, we found out, less interest, okay, less tax, and then divide by the number of shares, you get the EPS. Which is the highest EPS here? Highest EPS is alternative 1, 10.6. Raising debt of 5 lakh and equity of 15 lakh is recommended, which maximizes the earnings per share. Okay, the following data relates to two companies belonging to the same risk class. Same risk class. Why have they given this? Yes, that means they want you to equate VL and VU. Yes or no? They want you to equate VL and VU. 12% debt is 27 lakh for B Limited. Equity capitalization rate is, this is what KE. Yes or no? Equity capitalization rate is KE. Debt is 0. Therefore, can I say KEU is equals to 18%, which is equals to KO of the unlevered firm?
Yes, sir.
Sorry, of the levered firm, correct or not? Equal to the
Yes.
KO of the levered firm. Yes. So expected net operating income is 9 lakh. That means equilibrium. Yes or no? It is the same. So I mean, I can equate it. Same risk class with the same income. Same risk class with the same income. I can apply the approach. Determine the total market value, equity capitalization rate, and weighted average cost of capital for each company, assuming no taxes as per approach. Yes. So can you guys do this simple? Yes or no? Net operating income divided by KE Madre, you will get the value of the firm. Yes or no? This is the value of the unlevered firm. Correct. Net operating income given here is how much? 9 lakh. The capitalization rate is 18%. Correct or not? You divide it. You divide it, you get 50 lakhs. Clear?
Yes, sir.
Yes, sir.
Then KE of the unlevered firm is 18%. Therefore, KO of unlevered levered firm. KO of unlevered firm is also 18% only, obviously, because there's no debt there. However, the value of the levered firm is nothing but value of unlevered firm plus a debt into tax. But here there is no tax, Alva. First sub question, there is no tax, so this doesn't apply. VL is equals to VU a step. Computation of equity capitalization rate and weighted average cost of capital, net operating income, then debts. We have presented all the things again. We know the overall cost of capital. We've already done, yes or no? We've
Yes,
already done.
sir.
Yes, we've already done. For the unlevered firm. For the levered firm only, we need to do a step. For the levered firm, you find out what is the debt equity ratio, multiply the cost of capital and cost of debt respectively, a step. Overall will be 18. Yes or no? Overall is same. Correct or not? Overall is same. We need to find out only what is KD and what is KE a step. What is KD and KE, and then multiply into the respective weights. Clear, all of you?
Yes, sir.
Yes, sir.
Sir.
All right. Then when tax is present, remember the theory that we discussed. What will we find? First, find out what is the value of unlevered firm when tax is present. How is it? NOI into 1 minus T by KE, correct or not? Or KEU for that matter. This is 30 lakh plus tax advantage on debt. Plus tax advantage on debt. What is tax advantage on debt? 27 lakh is the debt into tax. That is tax advantage. So 48.8 lakh is VL. Okay. Weighted average cost of capital is nothing but same, 18%. Will it change? Yes.
Yes, sir.
All right. Of C Limited, that is the unlevered firm. It's already done. For the levered firm now, yes, this is B Limited. That is the levered firm. What is the cost of equity you need to find out? For that, we know the equation is very simple. NI by S. Find out what is the net income. We already found out what is the value. Yes, this is found out total value from this minus debt. Correct or not? Debt is 27 lakh. Value of equity is 13.8. Value of equity is 13.8. What is the net income? It is there. Yes. 9 lakh is given. You just have only difference now is tax. Only difference now when compared to before is the tax rate, yes or no? So that
Yes,
tax
sir.
you minus,
Yes.
then you find out what is the KE. Yes, what is the KE and overall cost of capital? Obviously, based on debt equity, this weights, you apply the weights and do it, you'll get 13.323 a step. The same thing is used here. The same thing they have used here. All right. Even this is same expansion plan related problem. Okay. Same thing we have discussed. Little different numbers are there. Do it.
Yes, sir.
Again.
Sir.
NOV Limited, an all equity finance company, is considering the repurchase of 275 lakhs equity shares to replace it with 15% debentures of the same amount. Okay. Yes, this is the last problem I'll be solving under this topic, and then we'll go to leverages, which will quickly get over. It's a very small chapter. Current market value of the company is 1,750 lakhs. Yes. And its cost of capital is 20%. Okay, now the company's earnings before interest and tax are expected to remain constant in future years. The company has a policy of distributing entire earnings as dividend. That means what is the dividend payout ratio?
100%.
100%.
100%. Assuming the corporate tax rate is as 30%, you are required to calculate the impact on the following account of the change in the capital structure as per approach. Approach with tax, obviously. Market value of the company, overall cost of capital, and K, and cost of equity. Okay, check here now. Yes, market value of equity is what? Net income divided by KE, yes or no? S is nothing but NI by KE. The same thing they've done here. Yes, market value of equity is given. KE is given. Can I find out net income?
Yes, sir.
Therefore,
Yes,
net income is what? Earnings after tax, because there is tax present now. Normally I say EBT, but in this case I'll say EAT. Yes. So earnings after tax is how much? Earnings after tax is 350 lakhs. That you divide it by tax, 1 minus 0.3. You get earnings before tax. That is 500 lakhs. Clear, all of you?
Yes, sir.
Yes, sir.
Yes, sir.
Income statement is 500 lakhs. They've given. Okay. EBIT, sorry. We have calculated just now. 500 lakhs. Interest when it is all equity and debt present. Okay, now 275 lakhs.
Sir.
If I replace my existing equity with the debt, I will have 275 lakhs of debt now, correct? Into 15% interest rate given, 41.25, 458.75, less tax at 30%. I get income available to equity shareholders is 321.12 and 350 and 350. Clear? Market
Yes,
value
sir.
of the company is value of unlevered firm plus tax advantage on debt. Value of unlevered firm, they've given this, yes or no?
Yes, sir.
Market value of equity, 1,750 is already given. Tax advantage on debt, debt is 275 into 0.3, it is 1832.5. Clear, all of you? Yes. Then what is the change in the market value of the company? Why? Because they're going for so what is the change? Before it was 1750, now it has become 182. So there is a change of 82.5 lakhs. The impact in the market value of the company has increased by 82.5 lakhs due to the replacement of equity with debt. Is this clear? See, don't forget, this is model with tax. Capital structure decisions are relevant. So obviously the market value will change with the present of debt. Did you understand? When you buy back, yes or no? When you replace your equity with debt, value is changing. Don't be surprised in value in model. How is the value changing? This model with tax. So obviously the value will change. Overall cost of capital, market value of equity is equals to market value of levered firm minus equity purchased. What is the value of equity? Total value minus equity repurchased. Total value is 1832.5. Equity purchased is 275 lakhs. Correct or not? Therefore,
Yes,
total value of equity is 1557.50. KE on this will be net income divided by value of equity. KE, that is net income. NI by S will be my KE. Net income 321.12. We found out here. Yes, 321.12. Correct. Divided by 1557.50, you get 20.62%. Cost of debt is again 15 minus 1 minus T, it is 10.50%. And then find out what is the overall cost of capital. Okay. That's it. Okay. This formula and all is not, you can know just for knowledge purpose, you can know. If at all, if no other information is given, how do you find out? You can use this formula, that is KEU, cost of equity of the levered firm into unlevered firm into 1 minus C. Before I used to say when there is no tax. See, listen, when there is no tax, VL is equals to VU. Yes or no?
Yes, sir.
Therefore,
Yes,
I used to say cost of equity of the unlevered firm will be equal to cost of overall capital of the levered firm.
Yes, sir.
But now if there is tax, will this equation hold true? It will not hold true. So to give effect to that, KEU into 1 minus open bracket tax into debt equity. Artha?
Yes, sir.
Okay. Into debt equity to give effect to that tax rate. That is the formula that we used. We'll get the same answer what we got. Okay.
Yes, sir.
ಅಷ್ಟೇ. ಇಲ್ಲೇನ್ ಮಾಡಿ, this is wrong. This should be why debt plus equity is just debt. Debt divided by equity ಅಷ್ಟೇ. Have they done it properly or not? KE. Acha, this is overall cost of capital. Okay, fine. For overall cost of capital, you have to do this. Okay, it's right. For overall cost of capital, you need to have debt plus equity also because it's overall. Yes or no? Only when you're doing KE, you will take only value of equity. Artha aita? Ad note down ಮಾಡ್ಕೊಂಬಿಡಿ. Don't get confused. Okay, but in the examination, I would suggest you to just go with the approach we have done on top. Aste. This is only for knowledge. In case of a question being asked with limited information for you to calculate. Artha aita? I would
Yes,
want
sir.
you to just il tanga aste saku. This is what you have to do. Normal, because this is easy, whatever we have done. Idikke conceptually just know how to form the equation aste. Again, this is same. MM model with tax and without tax. Same thing is done. This is actually your cost of capital problem. You solve it along with cost of capital.
Yes, sir.
This problem question is answer is not correct. This also I told her to share it in the group. I think some of you would have received, others you can take it. Okay, this answer MTP September 22. This question answer is wrong in this book. We have shared it. Okay, check that. Okay, Leo Limited, anyway, I'll be screen sharing it now. Leo Limited has a net operating income of 21.6 lakhs and total capitalization of 120 lakhs. Okay, the company is evaluating the options to introduce debt financing in capital structure, and the following information is available at various level of debt value. Okay, interest rate is given, equity. So this is KE. Yes, this is my KD. You need to find out what is KO. Aste. Godaita? You are required to compute the equity capitalization rate if approach is followed. Assume that the firm operates in zero tax regime and calculations to be based on book values. Okay, so if you know there is a formula, yes or no, for KO formula, let me share. Take care. Okay, as per approach, cost of capital remains constant, yes or no? KO should remain constant, no? KO should remain constant. So find out what the KO is under approach. So okay, under approach. Yes, under approach, when there is no tax, KO is constant, yes or no? Because nothing but my NOI. It's nothing but my NOI. So that is value of the firm is net operating income by KO. Value of the firm they've given in the question. Okay, they've given this. It is 120 lakhs, and net operating income is given 21.6. Therefore, KO is 18%. I hope I'm clear. Yes. So value of equity in a 100% equity firm will be same 120. Then it will keep reducing. Yes or no? Then you keep exchanging this. Okay. That is also given. Ali question only it is there. Okay. Check here. Okay, 10, 20, 30, 40, 50, 60, 70, 80. Total is here 120 lakhs. Total is here 120 lakhs. The same thing they have done here. Okay, now. So 120, and then they found out what is the debt equity ratio. So debt equity ratio is found out, debt divided by equity they have done. KD is here, KO is here. KO is constant 18. KD is given in the question 7, 7, 7.5, 8, 8.5. Correct or not? It is increasing. Yes, it is increasing. Therefore, KO minus KD formula. KE formula gottalva? Everybody knows this formula.
Yes,
KE
sir.
is equals to KO plus KO minus KD into debt by equity. Use this equation. Why? Because it is approach. For and NOI, you can use this equation. Yes or no?
Yes.
Yes. Aste. Use that thing, and then there is a theory question asking for remedies of over-capitalization. What are the remedies? How do I rectify it? Okay. Company should go for reorganization, buyback of shares. Okay. buyback of shares, reduction in claims of debenture holders and creditors, value of shares may be reduced. This will result in sufficient funds for the company to carry out replacement of the assets because over-capitalization agide. Better replace the assets. Clear?
Yes, sir.
Yes, sir.
Yes.
MTP October 22 problem, you guys solve it. It's on your own you solve because now if I discuss, it's a lengthy problem. You go through it. Okay now. Little different kind is there, wherein all the cost of capital knowledge, then even your capital structure, everything combined is there. Okay. Adana go through Madi. All of you understood?
Yes, sir.
Yes, sir.
Okay.
Yes, sir.
Yes. Now quickly let's do leverages and then we can end the class. Okay now. Yes. Now come to your revision material. Page number heading.
25.
Yes. Financing decision, that is your leverages. Okay. It represents what? It is the influence or power of one financial variable over the other related financial variable. Yes or no? Operating leverage. What is operating leverage? Yes, it calculates what? It represents my business risk. Correct or not? Yes. Financial leverage. What does it show? It represents what? My financial risk. Both of them combined is my combined leverage. What does it say? It shows my total risk. Yes,
Yes, sir.
combined. So that is my leverage. So here, what is the formula? Yes, what is the formula for operating leverage? So if you check here, it is nothing but if I remember this, if you know this profitability statement, one over the other, correct or not? One over the other. What now? Leverage, operating leverage is main factor is what? Fixed cost. Yes or no? Because if today fixed cost is there, next year the fixed cost is constant. Therefore, a small push in my sales will lead to a greater push in my profit. A small increase in sales will increase my profit much more than the same percentage of the sales. Yes or no? Because fixed cost percentage is remaining constant. So since fixed cost is the one I told you, one above and one below. One above and one below. This is my operating leverage formula. Yes or no?
Yes, sir.
Yes. Yes. Then financial leverage is here. Financial leverage is based on interest. Again, interest is constant. Therefore, interest will create a financial leverage. Yes. So one above and one below. Yes. So that is why the formula is here. Now, those formulas we'll do later. But the basic formula. Yes. Operating leverage. This should come to the next line. Operating leverage is equals to contribution divided by EBIT. Yes, all of you agree? Operating leverage is nothing but contribution by EBIT, and there it is what? Here it is what? Yes, EBIT and EBT, correct? Those two are divided to find out financial leverage. Okay. Yes. Degree of operating leverage, another formula is what? I told you it is the relationship between the sales and my EBIT. Yes or no? It's the relationship between sales and EBIT. What is the percentage change in EBIT for a percentage change in sales? Correct or not? If sales say increases by 10% and EBIT increases by 20%, what is the degree on operating leverage? It's 2. Yes or no? Twice the rate it is increasing. Therefore, it's the relationship between EBIT and sales. Clear, all of you? Percentage change in EBIT divided by percentage change in sales is degree of operating leverage. Okay. Next. Break-even point, this you already know. Fixed cost by contribution per unit. Margin of safety formula, all of you know. Sales minus break-even sales is margin of safety divided by sales. Okay. Divided by sales, this is margin of safety percentage formula. Correct? Margin of safety percentage formula. So using this equation itself, when you multiply PVR by PVR to both numerator and denominator and solve for the equation, you get what? Yes, you get degree of operating leverage is nothing but is inversely proportional to my margin of safety. Okay, now. Yes, EBIT by contribution. It is EBIT by contribution, but whereas, what is my degree of operating leverage? Tell me.
Contribution by EBIT.
Contribution by EBIT. So can I say this is inversely related? So degree of operating leverage is nothing but margin of safety is nothing but 1 by degree of operating leverage. Did you understand? Or vice versa. It's inversely related because EBIT is in the numerator, contribution is denominator here. Clear, all of you?
Yes, sir.
Now, financial leverage, it's the relationship between percentage change in EBIT and percentage change in EPS. Okay? Yes or no? Percentage change in EBIT divided by percentage change in EPS. So, your operating leverage is a relationship between sales and EBIT. It is a sales and EBIT. Here it is what? Percentage change in EPS divided by percentage in EBIT is equals to EBIT by EBT. Clear, all of you? EBIT divided by EBIT. Okay. Financial leverage as a double-edged sword. Why double-edged sword? Because yes, more the debt. Yes, capital employed will increase, but interest will be at the same percentage of 10%, correct or not? But say my return on investment is 20%. So more and more debt I take, more and more investments I can make, more and more 20% return I get, but I am only paying 10%. Therefore, I'm saving on the balance 10% and earning on it, yes or no? So it is beneficial. So whenever I do good in the business, obviously my returns will be multifold because of the leverage of interest. All of you understood. That is my financial leverage. But it is a double-edged sword. Why? Because if it decreases, the sales decreases, the impact on the loss, profit reduces also in the same ratio. Correct or not? At what rate it increases, at the same rate it will come down. So it is going to, that is why we call it as a double-edged sword. Artha aita? Yes, that is the concept. Ivaga theoretically you see, when fixed cost fund, yes, is less than I, that is nothing but I is less than ROI. That's what I say, correct or not? Financial leverage will help to increase return on equity, correct or not? Yes. When cost of debt is more than my return on investment, it will affect ROE and EPS unfavorably and result and firm can be under financial distress. Hence, financial leverage is known as a double-edged sword. Artha aita? Yes, so that is my ROI and interest relationship. Correct? The chart I shared on top also. That is double-edged sword. Combined leverage is nothing but degree of operating leverage into financial leverage. Formula is contribution by EBIT. Here it is EBIT by EBT. Both will get cancelled. So I can say it's nothing but contribution divided by EBT. Yes or no? Contribution by EBT. Other formula, second formula is what? Percentage change in EBIT. Yes, EBIT divided by percentage change in sales. Correct or not?
Yes, sir.
This is my operating leverage. What is financial leverage? Percentage change in what? EBIT divided by, percentage change in EPS divided by percentage change in EBIT. Here also EBIT will get cancelled. So combined leverage is nothing but percentage change in EPS divided by percentage change in sales. Did you all understand this?
Yes, sir.
Yes, sir.
Yes, that is what is given here. Then last table of interpretation, degree of operating leverage, financial leverage, and degree of combined leverage. When degree of operating leverage is low, degree of financial leverage is low. Obviously, low will total risk will be low, correct or not? However, when degree of operating leverage is high, financial leverage is also high, total risk is obviously high. When operating leverage is high, but financial leverage is low, I call it as moderate total risk. Because it is balancing out, yes or no? It is balancing out. But it is not a good combination since lower EBIT due to higher degree of operating leverage. Artha aita? Yes.
Yes, sir.
When this is low, but financial leverage is high. Financial leverage is what is going to boost my EPS.
Yes.
Yes. So moderate total risk here also, because both are offsetting each other. However, it is a best combination since higher financial risk is balanced by lower total business risk. Okay. Higher financial risk is balanced by higher total business risk. That's it. Yes. Problems page number, you tell me.
182.
Sorry.
182.
82.
182. Financing decisions, that is leverages RTP. This is your examination RTP. The capital structure of ABC Limited for the year ended 31st March 22 consisted as follows. Equity capital is given, debentures are given. During the year, sales decreased to, very important, the word to, by, from, arthakta idya? Understand, each and every word has a different. Decreased to 1 lakh units as compared to 1,20,000 units in the previous year. That means what is the percentage change in sales? What the percentage change in sales? It is compared to 1,20,000. It is decreased to 1 lakh. Correct. So there is a change of 20,000 units. Okay. But you need to divide it by what? That is important. Okay.
20.
1 lakh.
However, selling price stood at 15 per unit and variable cost at 10 per unit for both years. The fixed expenses were at 2 lakh per annum and the income tax rate is 30%. You're required to calculate the following: degree of financial leverage at 1,20,000 and 1 lakh, at 1,20,000 and 1 lakh, and then percentage change in EPS. Okay, na? Change here. Check here. Sales value. Selling price is how much? 15 per unit. 15. The number of units produced is 1,20,000 and 1 lakh. So multiply into 15. Okay, you get the sales value. Clear? Next, variable cost. Variable cost is also given. How much? 10 per unit. So 10 into 1,20,000 is 12 lakh, and then 10 into 1 lakh is 10 lakh. Contribution is found out. Fixed expenses is given in the question 2 lakh. EBIT minus it. Debenture interest given in the question 10% of 100% each, 20 lakh. So it is 2 lakh and 2 lakh, correct? 2 lakh and 2 lakh. Okay. EBT is 2 lakh and 1 lakh. Tax rate at 30%. You get profit after tax of 1,40,000 and 70,000. Therefore, financial leverage now we can find out. Yes. What is financial leverage? EBIT by EBT. That is 4 lakh by 2 lakh. Here it is 2. And here it is how much? 3. Correct or not?
Yes, sir.
Here it is 2, here it is 3. Next, operating leverage, contribution by EBIT, that is 6 lakh by 4 lakh, 5 lakh by 3 lakh, so 1.5 and 1.67. Earnings per share is earnings after tax divided by number of shares, 20,000 in both the cases. So it is rupees 7 and rupees 3.5. Percentage change in EPS or decrease in EPS is what? From 7, it is decreasing to 3.5. So 7 minus 3.5 divided by 7, 50% decrease. Clear, all of you?
Yes, sir.
Yes. Clear. Trading on equity. Similar concept, that double its word head, that is the same thing. Okay. Financial leverage indicates the use of funds with fixed cost like long-term debts and preferential capital along with equity share capital, which is known as trading on equity. So you're using fixed fund cost. When you use the fixed cost funds, you call it as trading on equity. The basic aim of financial leverage is to increase earnings available to equity shareholders using the fixed cost funds. Correct or not? Yes. Using the fixed cost funds, a firm is known to have a positive or favorable leverage. When is it favorable? When it is a favorable financial leverage, tell me. When obviously your return on investment is more than interest. Yes, same thing that are written. Check. When its earnings are more than the cost of debt. Net earnings, basically they're saying when the earnings after tax, your earnings, net earnings is more than the cost of debt. That is KE. Yes or no? When KE is more than the cost of debt, that is here written. Basically, there's nothing but ROI and IE relationship. All right. Again, simple problem. See, this is your question paper problem. I think in your compulsory question for 5 marks. Look at the question now. Total contribution 4,25,000. Operating leverage is given. 15% preferences or rupees 100 each. 1,000 is given. Number of equity shares 2,500. Tax rate 50%. Calculate EPS of X Limited. If 40% decrease in sales will result EPS to 0. Yeah, formula. Degree of operating leverage is equals to, degree of combined leverage is equals to percentage change in EPS divided by percentage change in sales. Yes or no?
Yes, sir.
Yes, they have written now. What have we found out? Calculate a 40% decrease in sales. So 40% they have written here will result in what? 100% reduction in my EPS. If it has become
Yes.
0, it has become 100%. Correct or not? Degree of combined leverage is what then? You need to find out. Using this equation, you can easily find out. Next. Operating leverage, see, contribution divided by EBIT. Operating leverage is 3.2125. They have given. Total contribution is 4.425. Can I find out EBIT? Yes or no?
Yes, sir.
Yes. So contribution is 4,25,000 divided by EBIT is equals to 3.125. Cross multiply. EBIT is 1,36,000. Degree of combined leverage. See, they've used the same formula. Percentage change in EPS divided by percentage change in sales is equals to combined leverage. Yes. That is 100 by 40, that is 2.5. Clear, all of you?
Yes, sir.
Using the combined leverage formula and operating leverage formula, operating leverage answer of 3.25. Can we find out financial leverage?
Yes,
Yes.
sir.
As a balancing figure, it is 0.8. Okay. Financial leverage is found out, and you know what is EBIT. In number 1, you found out. Now we can find out EBT. We can find out EBT using the formula EBIT by EBT. All of you are able to understand this?
Yes, sir.
Yes. 1,36,000 divided by EBT is equals to 0.8. So EBT is 1,70,000. Calculation of EPS of X Limited. EBT is 1,70,000. Then you found 20% tax rate, earnings after tax, preference dividend, and then you can find out EPS using all the answers we have already found out. The selected financial data of A, B, and C companies for the current year ended 31st March are as follows. Variable expenses as a percentage of sales is given. Okay. Interest is given. Degree of operating leverage, degree of financial leverage, and tax rate is given. Prepare income statement. Easy problem. Okay, na? Easy. Only thing you should remember, start with this financial leverage. Why? Because degree of financial leverage is equals to what? EBIT divided by EBT. Yes or no?
Yes, sir.
EBT is what? Nothing but EBIT minus interest. In the numerator, you have EBIT. Artha agta idya?
Yes, sir.
Yes, sir.
Which is equals to degree of financial leverage. Degree of financial leverage they have given. Okay. Interest they have given. Can you find out EBIT?
Yes, sir.
Yes, sir.
Yes. So that is the starting point. That's all. See, same formula they've used. Yes. So, but you don't have to do all of this. Idella beda. Math, don't make it mathematics. Just substitute the values. You'll get the answer. Did you get it? Degree
Yes,
of financial
sir.
leverage. Degree of financial leverage is how much? Here, 3. Yes or no? Degree of financial leverage is 3. Is equals to EBIT is not known. Call it S, X, then X minus interest is how much? 1 lakh. Just do it and solve for X a step.
Yes,
Okay.
sir.
Solve for X, you'll get the answer for both. Here it is. Okay, for all the 3, a step. That's it. Then the same, that is the starting point. Once you solve that, then one by one, everything will follow. Okay. One by one, everything will follow. Either commentary is important that you should write properly. Okay. Of all companies, A has the highest degree of operating leverage. B has the highest degree of financial leverage. C is equally leveraged. Check now. Leverages are given here. Yes or no? Highest degree of financial leverage, 4 is highest in A, correct or not? Yes, operating leverage, sorry. Financial leverage is highest in B, 5.
Yes, sir.
Whereas C is average, 2.5 and 2.5. Okay. Is equally leveraged on both. If you consider combined leverage, companies will have the leverages of, you have to multiply both. Clear? Your degree of operating leverage into degree of financial leverage is nothing but degree of combined leverage. Yes or no?
Yes, sir.
Yes. Multiply both. That's how they've got this 12, 15 and 6.25. This means A is undertaking a higher degree of operating risk. Correct or not? Operating risk is the highest. Degree of operating leverage is highest for A, while B is undertaking a highest degree of financial risk. Clear? But combined leverage of A is lower than B. That also one more additional observation you can write. Combined leverage of A is lower than B. Yes or no?
Yes, sir.
Yes. Again, you have to prepare a P&L statement using the information given based on leverages. Clear?
Yes,
Leverage
sir.
formulas you have to use and find out what is the financial leverage. See, same thing. I've told you this. This is the important one. Starting point in many places will be your financial leverage. Artha agta idya?
Yes, sir.
Yes, sir.
In many
Yes,
places, especially P&L statement, EPS you have to find out, etc., etc. You start with financial in many places. Number 22. Again, expansion plan of 78 lakh. Okay, this is a combination of your marginal cost of capital and your financial leverage and operating leverage, the formula. Okay, now, so your capital structurally EPS relationship we just did, yes or no? So that they've combined it with financial leverage. I've done this problem in the class. I've done this problem and I've given you my observations. Okay, our problem now go through Madi again. Before going through this, go through that problem and then come to this. Okay, again, if I discuss, it will take time, it's a little lengthy. But I've solved this in the class. Okay, I've solved this in the class. Go through that. But it's fine. When does the company have a does the company have a favorable financial leverage? When it is favorable financial leverage?
ROI greater than I.
Okay, yes. So that is what you have to do a step. Check here. Return on capital employed. That's why they found out 15.46%. Okay, and interest is 10%. So it is favorable. Yes or no? So
Yes,
it is
sir.
favorable. Okay. Again, so based on margin of safety rated problem, you have to solve each different kind of problem. One problem at least you should solve minimum. Okay, this one, solve this, and the others also you should solve. But I'm telling, because this has margin of safety and etc., solve this once. Again, same thing, formula driven. This is okay. Here, check this. Earnings after tax 5% on sales. Okay, earnings after tax 5% on sales. Sales have been given, they're not. So this somewhere it will get used. Then degree of operating leverage is 4 times. What is degree of operating leverage? It is 4 times. 10% debenture. So all of you compulsorily solve this problem. Okay, solve this problem. Because one answer will lead to the other. One answer will lead to the other. Okay, 4 times. Then 10% debenture in capital structure is 3 lakhs. Variable cost is 6 lakhs. It's given. Okay, calculate financial leverage, combined leverage, calculate percentage change in earnings per share if sales increase by 5%. Working notes now, check. Earnings after tax is 5% on sales. Income tax rate is given. Therefore, can you find then what you find out? What is earnings before tax? Yes
sir.
or no? Now check here. Earnings after tax is 5% on sales. Income tax rate is 10%. Therefore, EBIT is 10% of sales. Did you all understand?
Yes, sir. Yes, sir.
Interest expense is 30,000. Why? Given here, 10% debenture in capital structure of 3 lakh. Correct? Earnings. So can you now find out, add interest to that and find out what is EBIT?
Yes, sir.
Yes, same thing that I've done here. Check here. So EBIT is equals to 10% of sales plus 30,000. This is equation 1. Degree of operating leverage is 4. Formula is contribution by EBIT is equals to 4. Find out an equation here also. Sales minus 6 lakh, that is variable cost. Sales minus variable cost is equals to 4 EBIT. This is my second equation. Substitute now. Substitute. Where is that? Equation 1. EBIT is 10% sales plus 30%, right? So substitute that. Then you can find out sales. Okay. Replacing EBIT. Then you can find out sales. Clear? Solve madlebeki problem. Okay na? That's it. Once sales is found out, then everything else you can find out one by one. Because sales is found out, variable cost, you can find out contribution. Yes or no? From contribution, you can minus using the operating leverage formula. Degree of operating leverage is equals to what? Contribution divided by EBIT.
Yeah.
If EBIT is found out, degree of operating leverage, you can find out contribution.
Yes, sir.
Yes, sir. Yes.
Yes. 1,50,000. Once this is found out, minus the interest, then you can find out EBT. Once EBIT is there, you can find earnings after tax, and then entire income statement can be prepared. That's it. In this Navya Limited problem, I've done similar type of problem in the class to go through this problem. Okay, don't miss it. Don't miss.
Yes, sir.
Okay, this is simple. Again, using equations, you solve the whole thing. But important is you need to give the comments. ಅರ್ಥ ಆಯ್ತಾ? Comments ಕೊಡಿ ಎಲ್ಲದಕ್ಕೂ. That is important. ನೆನ್ಪಿಟ್ಕೊಳ್ಳಿ, whenever they've given you this, comment ಕೊಡಿ. Okay, see here. They have only told you to, okay, so don't this comment they've asked. Don't forget on this comment. Go through the comments. Okay. Because in other problems, we have not given comments. You can always give 1 or 2 lines comments, safer. Okay. Always give 1 or 2 lines comments, it is safer. Again, all are similar types. Similar types, non different type idre, I would do it. Yes. Seed capital assistant is not this chapter, it is done. That's it, guys. I think 2:30 plan ಮಾಡಿದೆ, 15 minutes extend ಆಯ್ತು. I think going by my reputation, I think that is still good. Okay, na? Yes. So all the best, everybody. I think this is a final meet I will be having you guys with you guys before your examination. So all the best. I know it is tiring, but you have to keep that energy levels high. You have to revise. No, revisions will happen, and then make sure your energy levels are the highest during examination. Ashwatanga full dussagbeedi nivella. Okay na? Yes. So
Yes,
when it
sir.
comes to FM barvaga, dividend decisions and leverages, smallest chapter with the repetitive questions and high marks. Anybody skips this chapter is an idiot. Hange face ge ಹೇಳ್ತೀನಿ ನಾನು. Okay na? Yes, you choose whether you are an idiot or not. Yes. So dividend and leverages, no doubt. So don't keep it for a chick chapter. I'll keep it at the end. Don't do that. Yes, do a Pareto analysis. 80% of the marks, 20% the quantity. ಅದೆಲ್ಲ ಗೊತ್ತು ತಾನೆ. So highest value marks you get from these chapters with lowest efforts. So make sure you're thorough with this. Thorough all the different kind of problems and all easy irutte. Leverages and your dividend decisions and all do not miss at any cost. They will really give you very high marks. Okay. That's it. Okay. All the best, everybody. I know all of you will do very well. I'm eagerly waiting, not for your examinations, but for your results, for the good news that all of you will be messaging me saying that, sir, I got exemption. Sir, I got 95, I got 100. I'm expecting, yes, 100. ಯಾವ್ದೋ ಒಂದು ಸಬ್ಜೆಕ್ಟ್ ಅಲ್ಲಿ ಯಾರೊಬ್ಬ 100 ತಗೊಂಡ್ ಬರ್ಲೇಬೇಕು. Yes, costing ಅಲ್ಲಿ ಮಾಡಿ. Costing ಅಲ್ಲಿ definitely possible to get 100 on 100. Okay na? ಮಾಡಿ. Now in FM and economics also you can get Sakkadag analysis, so much of in-depth analysis all the faculties have given. You should be able to do it. Almost the entire revision material itself. Now, if I can go through it in probably 3 hours time, right? Why can't you guys do it? Probably, twice the effort or 3 times the effort of that. You can solve. Definitely, you can solve all the problems and go through the CAPS material or whatever we've done in the class. Adan maribedi. Go through Madi, important problems you would have marked, no, when you're solving that time, that you solve. Okay. Revision is all based on examination questions. So we have solved it here. Okay. Don't miss anything. All the best. Do very well. That's it. Then see you all in the pass out meet. And probably later on when you all, after your exams are over, in Kalam for Kalam or somewhere, you guys come, we'll all enjoy. But now study. Okay.
Yes, sir.
Bye all of you. Thank you so
Thank
much.
you, sir.
Thank you, sir.
Thank you, sir.
Thank you,
Bye, sir.
Bye, bye, bye.
Sir.